All right, because we got a great group here, and again, I think we're going to go over some stuff that a lot of people haven't heard before, and so I think it's important. So again, thanks to Julie for making the class go so well, and for Ed for holding it for us, Ed McFerrin. And by the way, got to give him a plug. The attorneys there are awesome. They do great work on all the aspects. I have a group I call the Silver Superheroes, and it includes people like yourselves and like attorneys that are really good at helping seniors. Just people who focus on that. I'm doing a lot with caregivers and Medicaid, Medicare, all those kind of things. So that's kind of my next phase of career is being a reverse mortgage loan officer and having a lot of people I can work with when I'm helping my seniors. So I thought I'd go. So my name is Mike England. I'm a loan officer with Fairway Mortgage. I'm a reverse mortgage specialist, a retirement mortgage specialist. There's different words we use. Sometimes if you use reverse in a conversation, you've already ended the conversation before it begins. So sometimes we like without Suzanne. Yeah, anyway, so, and I'll share more of that stuff with you as we go on, just about reverse mortgages to real estate agents. So, a lot in my industry, most of the loans are done through referral and often through financial planners or CPAs, and I work a lot with them. But I've been working for 34 years, really. 1991. I'm just gonna whatever that is. With real estate agents, right? Day one, I walked into an office with some rate sheets, and after I'd been a processor for about a year, then when I have the rate sheets, start talking to realtors, and that's what I've been doing ever since. So I know you guys are really the ones who can make this happen and making retirement in our country better, and that a lot of that is going to include a real estate agent. And it should almost every instance, I think, include a real estate agent as part of the transitions. So anyway, we'll get more into that. So I want to just go around quickly, kind of get a brief introduction for yourselves, and I like to do that because again, networking is my life, and I like to know who's doing what. In other words, what area you're serving, and anything real quick that you can share. So, some of you, of course, I know already, but I'll just let you go through. I'm going to start with Linda. You're first on my list. Oh, I see you're muted. Sorry. Would you please unmute? Wish they'd let me control that from this end. There you are. Right? Yeah. Okay, now I see you're unmuted, but I still don't hear you. So, and I'll go a little bit more. So, by the way, Linda, while you're getting that together, we got somebody's iPhone coming in. Um, So what I like to do is teach the class, go through it as just directly answer the questions you have when you have them, right? Not just wait till the end or something like that. So uh, your questions sometimes really apply to everybody. So it's often a good way to go. So I will, let's see, we got, okay. So yeah, that what I'm saying, part of the reason I start out with let me introduce yourself. Let's make sure you're able to pop off of mute and ask a question. That's how we do it. It usually works pretty well. We're all pretty good at taking our turns and whatnot. So, Linda, are you available yet? No, we do have the chat. If it ends up like that, you know, tech support, is not my strong suit. So I'm going to move on to Pam. Linda, if you if you get your sound in there, love to hear from you. Pam, tell us about you. We'll have you. There we go. Get to unmute. You're still muted. So um, now, again, if I don't come back to you, that means because they start moving the faces around on my Brady Bunch Hollywood Squares thing, and sometimes I forget who I've talked to already. So I'm going to move on to Mike. Mike, let's get you unmuted there. I'm going to think it's me if you're not getting off. Okay, I still have you muted, so I'm not sure.
Okay, can you hear?
There you are. All right, it works.
Thank you.
Thank you.
Yeah, Mike Yashkin, retired Navy, living here in Port Arthur, Washington. You and I have talked before a little bit, and we just have some more. I'll go through the presentation that you're going to provide, and I'll save my questions for when we meet.
Very good. Thanks, Mike. Thanks for being here.
You're welcome. Thank you.
Michelle, you're next. Looks like you're not even muted.
Nope, I unmuted. I was ready. Let's see. I've been doing real estate for 18 years and had my own mortgage company, did mortgages prior to that. I love it. I work with whoever's looking to buy or sell, but I do have a soft spot for seniors.
Oh, right on.
You need to go slower and you just give them time to digest before you lay the next thing on them. Yeah, I don't know. It's a good industry. It's a good life. I really like it. Wish they quit changing all the freaking rules and forms constantly in the software.
Right.
As soon as you get good at it, they change it.
Yeah.
But yeah. So
well, what area do you serve? Sorry, if I missed that. What
what?
area? What's your area of service?
Oh, I live in Graham and I do Thurston County, Lewis County, Pierce County, and King County.
Right on. Very cool. Yeah, that's good to know. So
yeah, and I work on
state.
referrals and repeat clients.
Awesome. Well, thanks for being here.
Yeah.
Karen, you're next on my list. And we're still muted.
Should be there right on your Zoom screen down at the corner. Unmute that.
Or sometimes just hitting the tab button works, right? So, all right, depending on type
or
of
hit your space bar. I don't ever understand.
Space bar, right? Right. That's what I meant. Yeah.
Yeah.
All right. What happens when I do that? No. Yeah. Well, I don't know.
You'll get it.
I'm muted. Karen, we'll get you in there again. Julie, I know you're gonna be around. If we get questions on in the chat, let me know because I'll jump on later.
Yeah.
I too much ADD to be multitasking. So, and I'm on focus on what we're doing. But so, sure. Shelly, I got you next. I've known you a while. I know you can unmute.
Oh, sorry.
Oh, there we go. Okay, Shelly, can you unmute? Nope. Where do we go? Now everybody moved on me. Right. Okay. Let's see. Lost Shelly. What? Okay. I'm going to Joy.
Good morning, everybody.
Good morning.
Joy. So I've been real estate agent since 2017. But I had like investment or real estate experience myself since 2014. So I was like an investor myself previously, and I'm just so fascinated about real estate. So my primary coverage is in King County, Skagit, and Whatcom counties.
Awesome. Well, that's good to know.
Thank you.
Skagit.
Yes.
Especially, yeah, and Whatcom, yeah.
So an island. I'm sorry.
Oh yeah, don't forget the islands. Yeah, right.
Yeah, as well.
Yeah, very cool. Awesome. Well, welcome, Joy. Thanks for sharing, and looking forward to having you here. Shelly, I'm still seeing you. Could you unmute and say hello? Shelly Peppernick. Okay, not unmuted though. Don't. Okay, you want to share? No, not really. Okay, and you don't have to. That's not part of the rules. Okay, let's see. I've got June. June Dominguez. Did I say your name?
Yes, can you hear me?
I hear you fine now. Yep.
Yeah, been in the business for 34 years here in Ketchup County.
Oh, 91, right? Just like me.
Yes.
Yeah. You got in there. Yeah. We missed. I guess all we missed really was the savings and loan, crisis, whatever, the late 80s. And and the crazy interest rates of then. But that's good. My whole career, I've been hearing about the '80s and what it was like. I mean, well, I was busy doing other stuff, but
Well, I'm just curious about this course because in 34 years, I have yet to see one or have come to me to be processed for a reverse mortgage.
okay, well, cool. We're gonna teach you all about it. Hopefully, we'll get to do some reverses. So, what area do you serve?
Oh, serving Kitsap County
Okay,
and Pierce County.
okay, awesome.
But nowadays, I've been driving to Seattle, King County, because the children of my previous clients are now making
Oh,
big
sure.
bucks and they have settled over there.
Yeah, and like me, some of your previous clients are now retiring, and I've done the full gamut. I've helped somebody buy a house for zero down, get into the house, enjoy the house, build up some equity, and then do a reverse mortgage later, and
Uh-huh.
have no payments. So I would say zero down to no payments ever, but I just can't do them all at once. So don't even try.
Yep.
Two separate things. All right. Let's see. Now, before I get too confused, we're gonna do so. Pam, have I talked to you already? I neither see you nor hear you. I'm gonna go on to Johnny. There's Johnny. Hey, Johnny. What area do you serve, Johnny? You're not unmuted.
Oh,
Here
sure.
we are.
Hi, I'm Johnny. I'm a real estate broker and a loan officer, sir, but I don't do too much reverse mortgage, so I'm going to understand more about it.
Cool. Well, it's all about the education. So good to have you here. Thank you. And
Thank you.
so I'm gonna if I missed anybody want to speak up, say hello. My screen has changed a little bit. I got it. Yeah. So anybody like to say hello?
Mike, can you hear me?
Yep, I hear you now,
This is
Pam.
Pam.
Hi there. Yep,
I, I, I don't, I don't know if I'm coming in or not.
I
I
hear
just
you.
see you
I hear
and
you.
the reverse mortgage sign. That's all I see. I don't see me.
Okay. I don't see you either. I don't see your camera, but I hear you.
Huh.
So which is, hey, there you are.
Am I here now?
Yep, you're
Okay.
here and see you.
Okay. I got it.
So welcome. What area do you serve?
I serve Kitsap, Mason.
Oh, cool.
I kind of go all over. Grace Harbor down there. I've sold a lot of property down there. And I just kind of go where the people want to go.
Sure.
Most of them, they like to buy property to retire or to invest in.
Yep.
So I've been doing it for almost 24 years. So I
Okay.
enjoy it.
Right on. Well, welcome. Thanks for being here. I'm
Mm.
going to go ahead and get on to some of our content here. Just you should
Do you
have.
see my face at all?
I see you. Yep.
Huh.
You're
Okay.
front and center now. So for me, but it's all about the different layouts we got. So cool. All right, everybody. Well, I'm going to start. You should be able to see the happy couple smiling at each other. Is the screen I'm trying to share? Let's see. Yes. Okay. And that should be the cover of the book you got. If I could change the class from time to time, but um, I just add stuff in, and you'll see if you see anything that's not in the book, that's because I added it in after we got our book. Just because I work again with CPAs and attorneys and other people, so when I teach them classes, it's a little different. But I try to add everything back in for the agents because you're the ones really, I mean, that I find are really the key and the core to the whole thing. So, again, that's our introduction, and we'll talk a little bit about the market, what's going on in the market, which is interesting. We'll go over why do seniors move, and which is, I'll tell you right now, it's to be closer to their grandkids most often. But now that I have a grandchild, I see what's up with that. The basics of reverse, so you really have an understanding, if not just for yourself, but for your clients. So when we're talking about it, what I don't want is anybody to be like, oh no, or either you got an opinion about it and you know about it, or you don't have an opinion about it because you don't know about it, which is fine. But we want more people who do know about it. So let's not have an unstable. Says I'm unstable. I'm not really. Okay, the property eligibility. You know, they're FHA loans. The product we're talking about here, for the most part, is FHA. The HECM, the home equity conversion mortgage, that is a specific program insured by FHA, and so we're going to focus on that. There are some other alternatives. More are coming available. We call those proprietary, or sometimes we call them jumbo. There are just other programs that aren't the FHA insured one, not usually to have all the flexibility and all the bells and whistles that the FHA one does, but sometimes it's a better fit. So we'll go over that a little bit. Um, Sales. So selling reverse mortgages, if it was easy, everybody'd be doing it. They're lucrative, they pay well, although there's a lot of work. I have a lot of loan officers that could do it, been doing it, loans as long as I have. Haven't really trained up on it and don't really want to figure, and it's a little late in the game to learn a new career basically, because it's totally different from other mortgages. It's a different mindset, different clients, and just having it, I don't know, more than 10 years ago, because that's how long I've been with Fairway, is when I've really started focusing on reverses. And it took a while to get the brain to kind of adapt to the whole idea. So, because it's the opposite of, a loan where you make payments and increase your equity. This is where you're starting to use some of that equity. So, again, so we'll give you examples. So we've done a lot of these loans. We can share with you a lot of the success stories. We do cover the tax implications a little bit. That's changing all the time, and I am not a tax professional, but there's some things people don't even have a clue that there are implications there. So I've done classes for CPAs, and as I'm talking to them, I said, "Now you guys you're the expert on this part, so let's hear what you have to say." So the solutions, because there's a lot of problems you can solve with these, and people don't understand the program, so they don't know. But there's things that most people wouldn't even think of that we could do with these, and I'll share that with you. And then again, the questions, just bring them as you got them, and I'll try to finish where there's enough time. But I'll also be available after the class, and for especially this weekend, because there's no Seahawk game, so nobody's asked me to help them with any open houses or anything. So I'm sure it'll happen. But so what is your opinion of reverse mortgages? Does anybody have an opinion already coming in here? A strong opinion, or typically the number one opinion I get on these is I don't know. That's why I'm here, to learn more about them. But some people come in with an opinion of some sort. Does just in general, do you have a feeling? Anybody want? I got something they want to share.
Sure.
Michelle, I see your hand.
I think they can be a great product for the right situation. Can help the seniors stay in their house.
Right. So that would be number two, right?
Yeah, that's
okay,
big.
some people.
It's not for everybody, but the ones it's good for is great.
Right. Cool. Thank you. That's for professionals. That's the best opinion to have, honestly.
And I also would like to just say, if I was to do one for somebody, I would never want somebody that had a loan officer that has not done them or have experience.
Yeah.
So if I get one, I'll call.
Yeah. Right on. Cool. And so my answer is number three. I think I will get one when I'm old enough. So I am 61 and 3/4. You got to be 62 to get one. So my plan has been to get one on my birthday, but it looks like I'm gonna have to hold off a little because we're probably gonna be moving, and I don't want to do one. I don't recommend doing one on a house you're gonna be leaving, because you're supposed to live there. That's one of the rules. And they're expensive, so you don't want to waste your money on a short-term loan, because they're about long-term, having security, and I'll get into that some more for you. So yeah.
How long should you live there?
If you plan on living there, at least 2 years minimum, at least 2 years, you're going to live there. I mean, because again, first thing, there is a fee with the FHA program. It's a 2% mortgage insurance fee, upfront fee that you pay based on the value of your house. So if your house is $700,000 value, that's $14,000 you're paying in mortgage insurance. So that's a fee, that's one-time fee, and it's not refundable. Now it does last with the house, meaning if you refinance down the road to get a lower rate or more money based on increase in value, you don't have to pay it again. You've paid it, right? You can do. I've done loans 2 or 3 times for people with reverse, and they don't have to pay that fee again. But it's a pretty big fee for a short-term loan. So that's why. But for the most part, we need people to stay in there at least for a year, because that's otherwise we have to buy back the loan, and then we lose all the money that we thought we were making, and that's not fun. But honestly, there's no prepayment penalty. A person could literally do this loan and turn around and sell it, but depending on their relationship with their loan officer. So yeah, so that's the now for me, I would more. I mean, that's the 2 years but in most cases, really, you want to know you're going to live there at least 5 years. I mean, that's my opinion. Because you're paying. It's part of your overall retirement planning, and you're like, I don't think that includes unless you're using one for a house that you couldn't get otherwise. Then it's worth it, right? It's better than a hard money loan, and it's a loan with that we don't is easier to get because there's no payments. So if you're putting a large down payment, you got a client who's putting down a large payment, and they, might qualify for reverse. They're over 62. One of them is over 62. Then you might look at it as at least it's worth looking at as an option. But because even loans, I mean they're not free either, right? Unless you got a HELOC, sometimes is can be pretty close to free. Even those we get in trouble if you pay them off right away. So because it's meant to be a loan for your home, not just a short term, which is where the hard money stuff comes in, and sometimes that's an option. But I call it hard money. There's other words, but it's not for owner occupied properties, and it's higher rates and higher fees, and but more flexible, obviously. So yeah, so I will probably wait till we find the place. We've been looking for. We got to figure out where we want to grow when we grow up, and so I'll talk more about that too, because that's important. So here's what is exciting about the idea of working with seniors and working because you don't have to do a reverse mortgage for a person who's over 62. When at Fairway, when we get a client and we type in their birthday, if it shows they're over 62, it automatically gives us a little red notice over in the corner that says they may qualify for reverse mortgage. You might want to look at that as an option because we got people 70, 75 doing 30-year fixed loans. Maybe that makes sense for them. Maybe they're going to pay it off early. Maybe they do a 15-year, maybe an adjustable of some sort. But anyway, quite often, at least they should know about the opportunity there. So there are 10,000 people a day. You may have heard this. They call it the silver tsunami of all the people who are turning 62 or 65, or Medicare, and that's a lot of new clients every day, right? In our country that are available, and it's still going on. We got to still quite a few more years for the baby boomers to still be reaching retirement age. Eventually, they'll all be there, and then again, baby boomers are specifically since it's so many people, right? That it's a pretty good opportunity there. It's actually right now it's the number one group of people growing and buying, and they got most of the real estate in the world. Right now it's at $13 trillion in home equity. That's not just the value of their home, that's equity above and beyond loans, right? That is there. So that tells us we've got a lot of lending opportunity. My personal favorite is for people to sell their house and then do more kind of a contingent deal where they sell their house. Their agent helps them get the house ready. We help them get the house ready to sell. Then they move to a house that's a better fit for them in retirement. Well, it fits a lot of people. Yeah, a lot of just think they can't do it. Don't realize they can do it. And they're going to take their equity. They're going to put it in a down payment. Then they're going to have a reverse mortgage and no payments on the house. So if they only have $500,000, but they want $1 million house, the reverse mortgage allows them to do that. And then they're still building equity. They also have no payment. So so I prefer doing that with people. And most people really, I mean, I have that conversation whenever I meet with somebody. Have you thought about selling? Are you sure you want to live here? That's one of the, I give them 2 or 3 options besides a reverse mortgage. one, have you thought about this? Have you thought about that? And do you have an agent you're working with? Because some people have already looked at selling and then decided they want to stay there, but they didn't know that they could go move closer to their grandkids or closer to hospitals and closer. Man, I got one client that's got she just fell down. The husband just fell down the stairs, and now they definitely want to hold off on doing a reverse. We're going to do a reverse purchase. We're going to get them into another house. And again, we can do it as a purchase, close it a couple weeks. It's a really good program. So, again, another reason why there's so many people who might want person with an iPhone wants to enter. So, is that there lots less people have savings? I know at least half the people there are living month to month, even in retirement. That seems crazy, right? To me. Let's hope none of us end up there, where you don't have some sort of nest egg, and but lots of people don't, and the ones who do, they realize they don't have enough money to last them throughout their retirement years if they live for a while, right? And most people want to live for a while, watch their grandkids grow up anyway. So there's less people have savings, and they're not prepared. A lot of people don't have will or a trust or anything set up, and they got kids. Or a lot of people are in marriages where they've both got kids from previous marriages, and that's complicated. And so you might want to now you can just go ahead and die, excuse me, and leave a mess. If your kids, I just sent out an email to all the kids saying, hey, are your parents prepared for retirement? Let's talk about them because they're also the biggest challenge on these things. The kids, they're like, I don't want my parents to get a reverse. They were going to use up all their equity. Then there's nothing left for me. And the people that really are excited about it often are the people who say, oh, I don't have any kids, or my kids are okay. They don't need me. I said, this is not just for those people. There's definitely options for everyone. So. There's fewer pensions. A pension you used to be able to count on your pension to have money. My mom, my grandfather, right? They had Boeing. They had pensions. Although I had, I was my mom's caregiver for a bunch of years there before she passed last year, and she had a pension and she had Social Security. I wish that part of what my passion about reverse mortgages is that of wishing I would have got her one during the recession when she sold her house back in 2010, I think it was, because we would have had so many more options. I've lived through it. My mother-in-law had one as well. And I saw how she did. She had one, and how that affected her, and how she's also passed, and saw how that affected her. So those are the people who really appreciate reverse mortgages. Problem is we can't talk to them about them because they're in heaven, right? So nobody's figured that one out yet. So they're not here to talk about them. Now what we do have left over is one of their three kids that didn't get as much money as they wanted, or didn't, have any money saved, and they thought that was going to be their retirement, is their parents' house, and there was less left than they thought. Maybe they didn't even know their parents were using some of the equity. So they have a lot to say about it. They have no clue. They don't talk about how all the money they got. My mother-in-law is a good example. She never missed she had very little income, very little assets, but she had a reverse, and she was when my kids were born, she showed up. She lived in Utah. She was up here every time when birthdays. Everybody always got their gifts. Everybody just assumes that people have unlimited money, especially kids whose parents have taken care of them. So. Anyway, so another reason why it's a big deal is there's a low return on investment. So you could just put your money in investments, but can you live on that? And now rates have been high lately. Hopefully they're continuing to go down, but they're still pretty low, historically, and that's not enough money to live on for the most case, as far as how much you're going to get from that. In general, it's pretty volatile. So people act like they've got these guarantees and all that, and not necessarily, but and it takes quite a bit of money if you want to just live on the interest. So 3/4 of the people are planning on delaying retirement, right? That's been the same statistic for a while now. And of course, retirement is also kind of getting pushed back, most likely on when you can get the best Social Security, and they could even push back Medicaid, right? So they got to do something, right? Because they're running out of money. So we don't know what they're going to do. But That just means more. You got to work longer. And another thing, the problem is people don't have long-term care insurance. So if you don't have a program that's going to help pay for the whatever you end up needing, whether it's an in-home care situation or, oh, we got Shelly back. Um, Shelly, you get on your phone, maybe. Anyway, so yeah, so a lot of
Sorry.
people don't have long-term care. Oh, I thought Julie popped in for a sec. Okay, so a lot of people don't have any long-term care plan, and they're going to need it. A lot of people, 30%, they're going to need either long-term care insurance or some sort of. So either the kid's going to take care of them, without a caregiver. I work a lot with caregivers because they're the heroes, the superheroes on a lot of these cases because they're the ones. Now some are paid, but not a lot. Some are paid, and a lot of the time it's just family members helping out. So generally, there's a greater need for security and certainty, especially the way about just. I mean, I'm not even going to talk about politics or I've refrained from that subject, at least with my people I'm doing business with. So, but yeah, so it's a scary world out there, and some side of security and certainty is important, and that's what we're trying to help provide. So another thing about and why I love the reverse purchase is how many of your clients are priced out of the market. They think they're in retirement age, over 62, at least one of them is, and they don't know, if there's no houses. So they're scared. They won't want to sell their house and buy another one unless they're cash, because then they don't have to worry about the interest rate. Or some of them, have maybe they could clear 700,000 that's not enough for $1 million house or that they really want. I've been dealing with that ever since my first one was a lady she was buying a $200,000 house. She was shopping out in Puyallup for a $200,000 house. That's what she had. That's what she had saved. She'd sold her house before, had it sitting there dwindling away, and went, okay, I need to buy a house. So she's out shopping with her agent, and they're like, she'd find something, and this is a few years ago, but it's still relevant. But we obviously know Puyallup. A lot of people selling the South End doesn't have $200,000 houses, and didn't. There were a couple available, but and it can't be so if there's a manufactured home to get a reverse, it's got to be on its own land, and it's got to be newer than 76. And it's got usually it's got to be a double wide. So there's opportunities. Even then, there were maybe one or two pops on that's like that, or something really in need of a lot of repair and not a lot of future potential. So she came to me and we talked about it a little bit more. And she was a processor; she understood a lot about this stuff. But I explained the reverse mortgage to her, and so she went shopping for that. She got a house for 300,000. That was actually available at the time. There were a bunch of them, and so she got the house, beautiful house, great, fairly new, good shape, and she was able to buy that, and she had a reverse and watch the equity build, and she ended up selling that to go live with her son, and ends up with a lot of money, a lot of equity, a lot of flexibility, which really what it comes down to is flexibility and liquidity, the ability to have some money available. I've seen that as an example. So that we say over 12 trillion, but the number keeps going up. I remember when we were talking about 5 trillion. Now it's at 13. But there is about 15 million people. That's a lot of folks to we can help with these programs. And so focusing as well as focusing on this niche is or niche or whatever you call it. Uh, Focusing on these folks is a smart thing, right? I know the millennials are wonderful, and there's a lot of them, and great to work with. I've been doing first time home buyer classes as long as some of you have that, and well, I started really during the recession last time because so many we were able to help so many people, even who lost their house, get into a house. They became a born again first time home buyer after 3 years, So we had a lot of that. I've loved that part, but I love this more. So uh, these people with large amount of down payment and good common sense. So anyway, the here's why most people tend to move. They say wanting to be closer to family. we all know that's really to be closer to grandkids. Not everybody, but a lot of people, that's the deal, right? The grandkids. Um, like I said, I've got one now down in Texas. My first grandchild from last year, he's less than a year old still, but Maximo is down there in Texas, and I've visited him. He's visited me, but I'd love to see him more. Um, wanting to reduce home expenses is a lot of people, and that's just you cut down the expense and the time expense of taking care of a larger house or a house with a big yard. That's a good reason a lot of people want to move. Also, change in health status. Some people, if you're not in an area. Sometimes some people aren't in an area that has a lot good medical available. I was on Vashon Island for a long time. I mean, there's really not suitable medical, for facilities. I don't think. You live somewhere with Tacoma. You've got three emergency rooms within a quarter mile of each other. Decide what you want to do. I mean, there's definitely options. Um, so, change in marital status is another big reason. That's a lot of folks that the silver divorce is a big one. And some people focus just on working with attorneys, and people are getting divorced. There's a specialty. I've never taken the class, but I've dealt with a lot of people going. I'm sure a lot of you have dealt with a lot of people going through the divorce, and keeps it interesting. But so a person could have, let's say, a couple's lived long enough together. They got a paid off house. They could actually now go both buy houses with no payment, right? Because one, they could cash out the one spouse, they take their money, go over and buy another house with a large down payment and a reverse mortgage. So it's actually a great alternative to other options in divorce. And then there's just empty nesting. I've been through that already. We had a really big house over on Vashon Island, really big yard, and then kids were gone. So my wife's out in the middle of nowhere, and I'm running around the state, doing meeting with people to do mortgages. Just we spend too much time apart, right? So we don't. That's not a great plan for retirement. Even if I am going to work through most of my retirement, I'm at least going to come home at a decent time. So I think that's important to a lot of people. So, and then some people just want the cash from the sale of their home. That's why some people are moving. Now, where they're moving to, though, if they're just taking the cash, they're going to put it in investments and rent, or maybe they're moving in with a family member, or maybe they're going into a long-term care facility. There's a lot of those, a lot of different variations on those. And I work with some of those folks to get, but I tell you, they're a great source of leads for agents. If you don't know any, you should have a couple of those placement agents, whatever they call the people whose job it is to find people a good assisted living facility to move into. Let's see. Okay. And that's it. My mom was the example I gave earlier. She cashed in and she had enough money. And I'll go over that as an example. But then she was renting the whole time. Was renting ever since, and that was my mistake because I should have got her into reverse. She could have been doing a lot better, and including left a greater legacy. So, but hey, we learn. A lot of loan officers don't know anything about reverse mortgages. I was one of them, and I had been in the business, 20 years before I got involved in them, and then realized some of the things I've been saying was wrong. It's embarrassing, but true. And luckily, I investigated more and learned more about it. Yeah, again, so roughly 36% of the people do not anticipate moving in retirement. That doesn't mean they're not gonna. I have one client, I helped him, he went to retire for King County Sheriff's Deputy. And so he moved to Arizona. I do loans in Arizona too. It's a great place for if you're focused on seniors. And so we moved down to Arizona. We helped him get a great house, and he was happy for a minute. I think health wise, he was started having some issues and thought he needed to be closer to family. So he went out to Ocean Shores, Grace Harbor, right? So a lot of retirees going out that way, and he didn't like that either. And so then he decided to move out to Shelton, which is another kind of popular retirement area out on the peninsula there. A lot of people retiring out that way. And he's happy there. Now he got both friends and the family and a good life. But now he was a VA. He hadn't built up equity until he retired. So he didn't start until he retired. So I was able to do VA loans for him, but similar to the situation with the reverse, because VA you're typically paying a couple percent for the VA funding fee. He was, and luckily because of the market, he was actually able to use the proceeds from the sale, even though he did like 3 purchases and sales within a little over a year, just making up his mind. So I mean, there's people out there who are going to move and they're going to move again, right? And maybe again. So just because they've moved, they think they're in their place. But I talked to folks that end up often they're not sure this is where they want to stay, right? And that's fine because we can help them again. I'll go back to their agent, make sure they're still in touch, and let's get back to work. So a lot of people have moved already, roughly a third, 37%, and then and that again, that doesn't mean they're not going to move again. And same with the people that do not anticipate moving, right? So you just never know. But again, still 27% of the people do anticipate moving and they haven't moved yet, right? So that's a lot of people, a lot of available people that are still out there ready to make some decisions. When interest rates went up, that slowed a lot of our just a lot of people just weren't interested in moving because they didn't want a higher interest rate. They loved their 2.5% loan and thought it was golden. It's still a payment they got to make for the 30-year period, so it might be an alternative to that. So then we got what type of homes people are moving to. So a lot of folks are going smaller. Right, half the people are going smaller. Sometimes smaller is better because I've had clients who actually moved to a more expensive home, but it was smaller because it was had more benefits. Whether you're going into a place that has more activities, 55 and older places, or waterfront. Like I'm one of those people who's, I'm going to demand waterfront on my next house, right? So, I want to stare out. If I could be home staring out at the something, I want it to be a nice waterfront view, maybe a lake. We're looking anyway. Um, but yeah, a lot of times smaller, less. There's good reasons for that. Less cost and easier to maintain. Some people actually go in larger or more expensive, and larger might be maybe you're doing a co-housing thing, maybe, or you got a larger family now, and I might be moving in with another person, and you need more room, or they've got kids, so on. That's happening a lot, and then a lot of people just pretty much a lateral move, same sized. A friend of mine calls that wide sizing, meaning moving, not up or down, but just a similar house, but might be a better fit. Like I had clients in who had moved basically across the street, down the street a little bit. They were across a busy street from the golf course, and they were in a split level. So they moved out of the split level into a ranch style home that was right on the golf course. I'm sure they checked if it's not one of the ones that's going to have golf balls flying into it all the time, but uh, they love that, and then they're in a much better fit, very happy in their home, and again, it was just about the same price. I've done that a few times, so it's a good way to move. So now here's some of the things people don't like about reverse mortgages because they think the bank's going to take your house, right? You're giving up your ownership. I mean, that is the prevalent. That is more people think that than people don't think that, even though it's absolutely untrue. So the fact is, the bank doesn't take your house any more than they do when you take out any kind of mortgage. They put a lien against it. On a reverse mortgage, we actually place 2 liens against it, which is a great asset protection tool. And it's also gives you liquidity on your house without having to worry about having to lose your home or to have somebody take some of the equity in it. Um, but the bank it's a deed of trust. Same thing. You don't have to leave unless you're out of the house for more than a year. All right. If you're going to be out of the house, you're not going to live there. You're not going to follow the rules of it, meaning you had to live there at least 6 months out of the year. You got to pay your taxes and insurance. As long as you do that, you don't have to give up your ownership ever. Right. So, well, unless one of you still living in the home. And then even when they do pass away, or usually it's for passing away when people aren't there for the home anymore, then your heirs will have up to a year to do something with the house. And we'll go over those options as well. So some people think they're too expensive, which is they can be. I mean, some people, if it's all about cost, if cost is the only factor, well, then I guess if cost was the only factor, I guess everybody would do a FISBO, right? I mean, I've been doing this a long time. Never done a FISBO. I know a lot about real estate. I would never thought of it, and I never recommend my clients do one. You know, because you all know more than me that that I'm sure you have that discussion regularly with people who are thinking about it. They probably don't even want to bring it up because they know you know it's a bad idea. The fact is, look, the fees. I mean, you know the NAR, you know, and the government going against the fees that agents charge. I mean, we know the values there. It's not even hard to justify, right? Well, same thing with reverse mortgage. I can show you where the value's there. So I'm less fixated on cost when you know there's the value is easy to deal with. But again, you know that $1.2 million house, that's the maximum amount we're going up to on these 1.2 million in value. You can go higher value, but we don't count that value, right? So that 1.2 million, that's $24,000, and you're paying in as a fee, right? So similar, you know the fees get up there with real estate fees. So not hard, I don't think. I've had people not do it because it's too expensive, right? And even though it was a great fit for them, and they just couldn't get over that. Some cultures are especially fixated on that. So it's whatever. You know, now that it's tax deductible, that just changed. So there's other tax implications that may make sense. But so yeah, so they think your heirs are going to end up with a big problem, right? When it's over. And if you structure things properly, I mean, as long as you have a will, and if you're in a trust, it's even better. It can pretty much just transfer very easily over to the people who are gonna to take it over, and it can never be more than the house. They can never owe more than the house is worth. When you go to sell the house, when your heirs go to sell the house, if it's upside down, which doesn't happen very often these days, but you know, who knows? I mean, there's been times when there were a bunch of upside down houses. If it's upside down, FHA has an automatic short sale, and they'll sell it for 95% of the appraised value. They send an appraiser out. Appraiser looks at the house, gives it a value. The FHA approved appraiser, and everybody gets a copy that's involved in the sale, and then you know what you can your agent can list it for, and it almost always works well. So I've had one so far, the one agent, because I get a lot of feedback from agents because I talk to a lot, and one had a time where the amount the appraiser said it was worth, she couldn't sell it for that. She couldn't sell it for that. Finally, she had to wait to get it reappraised, and then was able to sell the property. But usually, I've seen people actually, but they get it appraised, and then the person who buys it has some equity. It doesn't the seller doesn't care. I mean, you didn't have to pay anything, right? So if the value, it's kind of like the old short sales. I know some of you've had plenty of experience in the short sale world. You know, hey, the buyer got a good deal. It didn't come out of the seller's pocket because they did a short sale, right? So you might still say, "Bam, we went up in value. Darn it, I should have got more money." But anyway, so I've seen that as actual positive for the buyers. And it's fairly simple. So FHA does these short sales regularly, right? And they've got a system in place for it. When the loan gets to a point where it would be a short sale, if it's sold right then the servicing is transferred over to FHA. They run the programs. Usually it's held by the lender because that's how we make money. You know, is by holding the loan and getting the interest from it. But once it's transferred over to FHA, you know, then they're the ones. So now they've taken over and they're ready to process any short sales they have, or you know, if it doesn't short, it's just you just pay off the balance that you owe. So people think they're risky and dangerous. I don't. But I think not understanding them is risky and could be, I mean, it could be dangerous if somebody was to sell you one and it wasn't a good fit for you, or to charge you as, you know, everything they could get away with, because these fees are negotiable. So, you know, you got to have somebody selling it that cares about their community and the people that are in it, and the agents they're working with, and aren't overcharging on something. But it's you know, if somebody's getting one, you think, okay, well, this is a government program. It's all the same. We all have control over how much we charge. Okay, that's important to know. It's something not everybody will tell you, but there's actually it's all negotiable, right? So we can't negotiate the FHA fee. They don't let us pay it or to pay, although the seller can pay it. Or actually, the agents can pay it if they want. But you can also negotiate the deal so the seller's paying it, and that's fairly new. Those of you who have learned about these in the past, that's only been the last couple of years here where they've allowed the seller and or the agent to participate in paying closing costs. So that you could actually pay up to 6% of closing costs, which is typically going to be more than they are. Um, and then so the actual buyer doesn't even have to pay the closing cost in a purchase. All right, so quick overview. Let's see. I'm looking. Okay, we've got a few more minutes before I take a break. One thing I didn't mention at the top of the hour for 10 minutes, right? So 11 and 12, we're gonna take a 10-minute break. Close to the top of the hour as I can structure. So again, these are some of the basics. You keep the title to your home. Doesn't trans. You can have it in a trust. You can have it in your name. You can have it in both your names. You can even have another borrower who's on title but not on the loan. So we can do all these. Which is more flexible than a conventional or other loans are on that kind of thing. So there are basic credit and income qualifications. There was a time before 2015 where you literally had to fog a mirror because if you're alive and you can sign your papers or have a power of attorney, then you qualify because there's no credit. And if you got enough equity, you always had to have enough equity. But we didn't look at credit, we didn't look at income, and that was back before before say 2010, when I really didn't know as much about reverses. Um, I didn't even know that, and so I could remember. I still remember the one time a attorney referred somebody to me, a good friend that I'd done business with before, and I looked at her credit and thought, oh yeah, this I can't really qualify. Well, I could have, but I was wrong. So I hope that worked out for her later somehow. Somebody who knew what they were doing talked to her, or the bankruptcy ended up going through, whatever. Anyway, because guess what? You can't file bankruptcy if you got all your equity in your house. If you want to wipe out your revolving debt, typically, I mean, sometimes. So, or if you make too much, so you can't wipe out your debt. So, but you can do reverse, protect yourself, and then maybe later you're filing a bankruptcy or something. But so anyway, there are qualifications. It's easier than other loans. There's no credit score. There's just, did you pay your bills on time for the last 2 years, for the most part? If not, why not? Is there a good reason? We have real life people that underwriting the loans. The underwriters are experienced FHA reverse mortgage underwriters, and if you got a good story and you can back it up as to what happened, I've had plenty of good stories. I mean, people lost several family members within the time, or one of the family members was sick and couldn't help out, and was a large, had a lot of expenses. If some of the things that we're trying to prevent had happened to them before we were able to get them a reverse, hopefully then we can still get the loan done. If even not, there's alternative options for that as well. So if they got enough equity. So again, this is tax-free cash from equity. You're pulling money out. You don't pay taxes on the money you pulled out. That's not even overstepping my expertise. That you got definitely money you can pull out, and it's not considered income. It doesn't affect other things that you might have, whether Social Security or maybe Medicaid or other government related. Sometimes income is lower. Even business loans are easier to get. So that we don't have to count the income you pulled out of your reverse mortgage because it's not income, it's a loan. And that's real helpful in a lot of things. So I will look at later. So, and no matter what, there's never a monthly payment. I don't care if you use up all the equity that you had available to you, you still don't have to pay back the loan. It just means you can't pull any more money out. You have to live off the other money you have. But you never have to make a payment until both are no longer in the home, both or one, and be still responsible though for your maintenance of the house. Got to keep it up. It's not like we send out an inspector, say, hey, your lawn's too long, right? There's nothing like that. It's just like other, as you probably know, every deed of trust has certain guidelines for that you need to maintain the home when you're living there if you got a loan against it. So, And you got to pay your taxes, got to pay your homeowner's insurance. If there is an option for not pay those if you've got enough of equity, but usually that's for people who don't qualify because of their credit and their income. So we go ahead and pay their taxes and insurance for them to allow them to still get the reverse mortgage and get rid of the payments and whatnot. So that's what I got for now. Looks like, look at that. We're at 11 o'clock. Let's go ahead and take a 10-minute break. See y'all at 11:10. Go ahead and start us on the next slide. Okay, thanks everybody. I don't know about you, but that break really helps me. I think I just spent the whole thing thumbing out some replies on on my phone. So cool. I don't know. They don't have an auto reply for texting, do they? Maybe they do. Anyway, probably do, but I don't. So welcome back, everybody who's back. And I'm gonna make the assumption everybody's back, whether I can see you or not, because I'm sure you are. So you should
Mike, do
have.
you see me? This is Pam.
Hi, Pam. I do see you. Thank you.
You do see me?
Yep.
Okay, I'll unmute. Okay, I just want to make sure because I don't see myself on my
You can move around. You know,
screen.
I know you can move around the view. You can kind of decide. Let's see, what is it? There's a way to change what you're seeing. What is that? Layout? Uh,
You said layout?
no, I don't know. Let's see. I'm trying to remember now.
Because I do see you and I see what you are um for the reverse mortgage
Yeah,
thing. I
okay. Well,
do see that,
that's
but I
good.
don't
You can move
It's
around.
just a view screen in your Zoom, Pam, up there. It
views.
will
Okay,
say
okay,
view.
on top I have the speaker and then I have the camera and then it says Zoom.
Yeah, it's just the way that it's set up for how you have it. Like I have mine gallery, so you guys are all in a line.
Okay.
It's just you have to play with it a little bit.
Okay, well, if I can't find it, I'm okay.
You're fine.
Yeah, you're fine. You're
Okay.
fine.
Sorry, guys.
Thanks.
Thank you.
Thanks.
Thank you. Awesome. Awesome. Yeah, we obviously we want everybody to be able to see what's going on. I've talked on for a few minutes before and had people say, Mike, I can't see your screen. So that's really helpful for all of us. So everybody see the screen? Yes, we're talking about how the fact, yes, you do not need to repay the loan until the last living borrower permanently leaves the home. It's really strong because people have other conceptions of that. That means if there's two of you that are on, that are on the home, that if one passes away, the other one gets to stay there. Doesn't have to make any payments. There's a couple things there's different variations that allow us to open this up to more people. That where you don't both have to be on the loan because you may not both qualify. So sometimes we'll leave a party off the loan. Maybe they're, of course, we have to look at other people's obligations because it's an FHA loan if you're married, right? But if you're not, then we don't have to. And if they could still be, they can still have, you can still protect them. And I'll give you examples. So I told you I'm going to be 62 here in a few months, couple months, getting closer. And I'll be 62. My wife, though, is younger than me, right? So she's in her mid 50s, and so she won't be on the loan, right? So even if we did the one I'm living in now, or the one we're planning on moving into, I'll have a reverse mortgage. She will live with me, and she won't have access to the line of credit. If I have any money left, which I probably won't, I'll probably invest whatever I take out of my reverse. But if um, something were to happen to me, then she wouldn't have if there's money in the reverse, she doesn't have access to that. But again, there may not be if I don't leave any, and why would I if my wife can't get it? So anyway, but she would have the opportunity to live in that house for the rest of her life, even though she's only 55. If she was 40, right? Which hey, she was younger than that when we met. She'd still, I could get a reverse, and she would still be able to live in the house for the rest of her life. So that's can be beneficial. And again, the difference is why now it's not magic. What happens is if your spouse is younger than 62, we're going to count their age as the age we count for figuring out how much money you can borrow. Because there's three factors on this. There's the age of the youngest borrower or youngest homeowner who's protected, right? Because it's based on how long they're expected to live, and the younger you are, the longer you're expected to live. We don't do any medical checks or anything; it comes right off your age. So they're going to be So the loan amount we lend, the amount we approve you for, which is called the principal limit that we approve based at closing is going to be based on the age of the youngest borrower or homeowner, and the also the interest rate at the time, and then the value of the home. Three factors there. So that's why as time goes on, sometimes I've watched a few years ago, back in 2000 through 2002, 22, 2020 to 2022. Okay, especially there were a lot of people refinancing their reverse mortgages because they could actually the values had gone up from when they took it out the first time. The interest rates had gone down, and they've gone a little bit older, right? Not, the age doesn't as big a factor as the interest rate and as the value of the home. But the home goes up 100,000. That means they're able to refinance that reverse. And so, for instance, you're talking to somebody, they got a reverse mortgage, and they're like, "Well, I'm thinking about, what do we want to do? We don't have any money available to us on the reverse anymore. We're not making payments, but maybe we want to sell our house." That's where we love to have a conversation. You get a feel for what the value of their home is. What we They're the only ones who really know what their balance is, but they can share that with either you or me, and then we can just get their age, and I can figure out for them what's available, whether they want to borrow more money against their existing house or sell their house, buy another. We can totally show them, their options. That's good, important thing to know. And again, they can sell at any time. So it requires repayment. If they sell, they don't get to sell the house and keep the money, right? It pays off the loan, just like any mortgage. And no matter what, as I said, you could never owe more than the home value. The home owns the house. I mean, excuse me, the loan. The home owns the house. The home is the one that is responsible for paying back the loan. That makes sense. So it's a non-recourse loan, meaning the loan is not going to be, it's not going to affect the credit of the buyers. It's not going to affect the homeowners. It's not going to affect the taxes. They don't get hit with a 1099 if they pay if FHA pays off the balance. It doesn't show on their credit, because there's no payment, so it didn't even show in your credit report. If somebody has a reverse mortgage, nobody really knows how much they owe. All they know is what the deeds of trust look like on the property profile. So I've had agents come to me and say, "Mike, how do these people borrow 1.5 million? This house is only worth 700,000. Why are you guys lending so much money on houses?" Well, we don't. Trust me. The FHA doesn't want to be upside down on every one of these when people pass away. So we only lend about half the equity in the house. The rest is in the borrower's, still in their hands, right? So, but we record a couple of deeds of trust against the house for more than the value of the home. That's to protect the equity in the house. But the payoff is always just the interest that has accrued and the money that's been borrowed. And that's it. But the non-recourse option allows you, say you've got a house with a reverse mortgage on it, and there's problems in the market. It doesn't affect your other properties, your other houses, your other assets. There's no negative there. And again, the fact you can purchase a home, which is news to a lot of people, roughly, the older you are, the less you got to put down. I'm seeing from you have about 60% down, meaning about a 40% loan to value, up to maybe 40, 35% down as folks get older. But it's a lot down, definitely. So a lot of people who don't understand reverses will contact me about a reverse, and loan officers will send them to me thinking they could qualify, and I'm like, yeah, no. Okay, here's how it really works. But anyway, I like having that conversation anyway. So, and then there's the fact that the heirs have up to a year. So it's a 6-month initial period. They're telling, okay, we need to get this house paid off. So what they'll do is when your client or the parent or whomever passes away, their heirs who are listed on the loan application will get a letter. It's going to say, "We're sorry for," in the house. It'll come to the house as well. We're sorry for your loss, and we're here to help as much as we can. And they're pretty nice about it. And then they say, "Here's your options. You can sell the house. You can purchase the house yourselves, or you can always just do a deed in lieu of foreclosure, and work it out with the lender, and we can transfer the house over. So one way or the other, it can all be done, or you just do nothing. Some people can do nothing, just do nothing, and because they know there's no equity, so why bother? They don't even go through probate because if there's not a trust or something, then you got to go through probate to transfer ownership, and so some people don't want to deal with that. And if there's not enough equity to make it worth it, usually there is, and usually because of the fact 95% of the appraised value, and they pay the realtor fees and the other costs. It's like, I would always recommend to my clients, they do. I had an agent friend of mine, had parents passed away down in Miami, and he was a little condo, not very much money. And I didn't ask him after the fact. I just advised him that, hey, if he needs a referral, whatever, some help with that. But, they didn't have not a lot of equity. He didn't think it was really worth it. As I think, there's several family members too to split whatever they did get. So you just do nothing. Nobody gets hurt. So I think it is a good idea to work with the lender just to help them get it moved on off the market, right? So because it just helps everybody a little bit. So again, they give you 6 months plus two 90-day extensions. So I've seen somebody do nothing and they ended up the house goes to foreclosure because they do nothing. They don't respond. I mean, they're not going to wait till 11 months and 29 days. They expect you to get it done in the first 6 months, but you can get two extensions. Say you want to, if you long as you show them that you're going to list it, or planning on buying it and applied for a loan to get it done or something, they'll extend that out and potentially even further. So, but that's the rules. And then this is where I share what kind of how the money, how do you get the money? So, if we're doing a purchase, typically we're taking out a lump sum because we're helping the people to buy the house. So when they're doing a purchase, we're going to lend them money on the house they're buying. That means they have to have sold the house they were selling, so they close at the same time, right? We do contingent, but so say they got $1 million house, they're going to put 500,000 down. We're going to lend them the 500,000. That 500,000 goes to escrow just like any mortgage. Looks the same. There's a couple small differences in that, which we'll get into the purchase a little bit more. In that, those of you who've been around a long time, the HUD one is how we close these. Not the closing disclosure. We don't do the 3-day waiting period. We've been through so much counseling and so much conversation by the time we get to here that there's no reason. If it's a refinance, there's always a 3-day waiting period, but not on a purchase. But yeah, that's pretty much so. That's typically how it's done. That can still be done as a line of credit, which I recommend, because the line of credit is it's variable, it's adjustable, and it means it'll go down when rates go down. There's caps on it if it goes up, but it can only go up like 2%, typically 2% per year, and then 5% total. And then it can go down all the way down to the amounts of the index. And then the margin. So, so I like the line of credit because if that is open, meaning if you decide to put some more money, maybe you want to pay down the interest on it, then that money is available to you again later. If you take the fixed rate option, the lump sum, of course it's going to be, for one, you're going to have to put more down because it's a higher rate, therefore it's a lesser amount we lend, but also it's no flexibility. All you got to do there is not make payments. Whereas a line of credit, you can pay it down, you can pull it back out, you can pay it down. There's some advantage to that. And with the line of credit option, you've also got other options. So you can take a monthly payment. You can say, look, I want to get a certain amount for the rest of my life. And then we will figure out how much that is based on all the factors. And we can set your loan up that way. Or we can say, okay, I want a certain amount. Well, how much can I get for 5 years? And so we say, here's how much you qualify for 5 years if you want either and you can decide to just to get a monthly payment for the next 5 years and then do something different down the road. Or you can do all three. You can have take some money first up front, and then you take some as a line of credit, so you've got access to some money, and then you can also take some every month. So of course, you increase one, it decreases the others, right? It's only a certain amount available we're able to get. So my favorite probably way to a person to do this, do a line of credit to purchase a home with the line of credit and overfund it, meaning if they got more money than they need, there's a pretty good place to put some money that keeps it very safe, and that is your line of credit. Because your line of credit on a reverse mortgage grows by the interest rate every year. So you borrow, let's say rates are 6%, and you borrow $500,000. So you're paying $30,000 in interest every year, right? That's 6% of 500,000, right? Um, that so you're paying that amount, but you're not paying it because you don't have to pay it. It just accrues on top of your loan. And that accrual raises your line of credit, but since you've borrowed it all, there's none available to you. Well, if you have a difference between the amount you borrow and the amount you're approved for, that is called overfunding or putting more money in your line of credit so you have access to it later, and that portion is growing the same amount as the amount you borrowed. So you've got a portion there growing, say at 6%, as long as you have the loan, right? So that could actually, so the more you put down, or if you pay down more later, the more growth you have in your line of credit, and that could grow above the value of your home over time, because if the house doesn't go up as fast as the interest that accrues, because just like other loans, the interest does build on itself, compounds. Right? You've heard of compounding interest. So we do with our 401ks and our IRAs and other investments that you get interest on. After a while, it's building on itself, and so over 10, 20 years, starts going up and up and up. Well, that amount goes up whether you've borrowed it or not, so you have access to it. So you could actually, let's say you had got a reverse mortgage and you didn't need the money. That's what you really want in a reverse mortgage, even more so. I mean, unless you're desperate or in a tough position. If you've got a huge down payment, you take out the reverse mortgage, and it's growing all the time. Nobody can touch it, nobody can take it from you, nobody can stop you from getting the growth in it, and you can pull it out at any time. That's the liquidity that is so important in retirement. You can do what you want, take out 100,000, buy a house, flip it, turn around, take your profit, put the 100 plus hopefully more in, and pay down the balance sum. And then when you pay, by the way, when you paid it back, you get a tax deduction for the amount of interest that had accrued. So if most of it's interest, then you're getting a tax write off for what you paid, even though the money is available to you again, all over again. So anyway, so the options are there. It's good to go over them with your loan officer. We go over all these options also after we've talked, and we do what's called a proposal. That's how we start the ball rolling on a reverse mortgage. We do a proposal. We can do one even, one that doesn't even if we don't have all the facts, right? I'm happy to send one out. And again, what do we need? We need the value of the house. We need the youngest borrower's age. It's nice to have the house address so I can look up the value. But as an agent, if you've got a good feel for the value, just want to give me that. That's cool too. I'm not going to contact anybody without permission. And then we run a proposal. So the proposal shows them the terms that are available and the different options that are available, and a lot more information. It's like 30 some pages. So actually it's 60 pages if you count the booklet goes with it. So we send the proposal out, and at that point, the person is able to take the proposal and go to a HUD counselor to review the proposal. And so they could do that on the phone. We give them a list. Part of the proposal is a list of people to contact, and we've got a list that says contact these people. Here's their number. We don't get to tell them which one to use because that would be steering, kind of like it used to be with appraisals, right? So anyway, so then you're able to move forward once they've gone through the counseling, and they've got a certificate that comes from the counselor, and they sign it, and that makes it what's official, where you can actually order an appraisal on their property or start the whole pre-approval process of going out and buying a house, because by then we want to have them qualified and ready to go out and buy a house. But the counseling also helps make sure they understand everything. My job is to sell reverse mortgages, right? Now, my personal job is to educate people and make sure they understand what they're doing and make sure we're doing the best for them and working with their other partners. But the counselor, that's all they have no skin in the game. Their job is strictly to make sure you understand it, make sure the paperwork is correct. They review the paperwork that I send them, so they get a copy of it, and then now we're moving forward. There's always something. I mean, because you can keep asking questions of people until you find something they don't know, and then even if they've been through a class, even if they've been spent with me for 2 hours, there's always going to be something. So there's always I like that aspect. Plus, it makes sure other players in the game aren't able to pull the wool over anybody's eyes and do have them do something they probably shouldn't. So anyway, that's a good part. And then of course once we get the application in, we can order the appraisal and continue on with the purchase if it's purchase or refinance if that's the case. So again, some basics. You got to be 62 or older. At least one of you does. Um, the older you are, the more you can borrow. But you actually are better off taking it earlier because you're going to get more money in accrued interest, interest available to you than you are as far as the increase you get by having a higher age, right? So it does not make sense to wait if you qualify, right? Otherwise, I wouldn't do it when I'm 62. Like, it's kind of like Social Security. You think, oh, well, if I wait longer, I get more money. Well, it depends. Depends on how long you live and other factors. So, um, anyway, so it's an FHA home, just like any FHA deal you done. We are gonna the same appraiser we use for conventional typically, but it's from our panel that we have. Fairway. I can speak to Fairway. I can't speak to other companies. Fairway, we have a panel that is actually co-owned by the company, but we're very strict on the guidelines. I don't get to talk to the appraiser, that sort of thing, and they randomly choose who's going to do the appraisal. And but still, so they're FHA, they're qualified, and they're going to do a couple things, right? Peeling paint's always a pain. They're going to look up in the attic. They're going to look in the crawl space. For me, work orders are slightly more likely than when conventional, but for the most part, we're pretty easy on those. So something needs to be done, and we can take care of it. One thing to know, and just ahead of time, on a reverse mortgage, there's always the potential for a second appraisal. Right now, a lot of loans have that, and we don't really look forward to that. And if that happens, they added that as a few years ago. They decided the appraisers were getting a little too freewheeling with their values, and they decided they're gonna, if they see the value doesn't seem to be supported, they're gonna ask for a second one. So all that means is it's another appraisal. As long as that one comes in as high or higher, we're fine. If it comes in lower, we're gonna have to go off that lower amount. So we'll order that. We only know when we order that once we've got the client and the property, under contract, and we're able to order an appraisal. Then when the appraisal comes in the underwriter, that's when we find out whether or not they're willing, to require a second appraisal. And in which case, what we do is we do that up front, right? So we go ahead and order it behind the first, and make sure they know that we're going to cancel it if we don't end up needing another appraisal, but we want to get in line with it so that it doesn't hold up at closing. So anyway, and I'd say my experience is it's only maybe 10% of the time that they actually do that. So and if the value's there, it. If it's a tough one, that could be a challenge, right? So we already know that going on a purchase, we already kind of know that. So again, you got to live there 6 months a year. We don't put a ankle bracelet on people. We're not checking when you come, when you go. We just know that the underwriting file has to look like it makes sense. You're going to live there at least 6 months a year, right? And then we're gonna ask you once a year. You still there? We're going to send a letter. We send a letter every month that says, here's your loan, here's your balance, here's your how much you have left to borrow, and here's some how the different factors of what's going on, how much it increased this month, and here's another form that says, do you want any more money, right? So we get that every month, and then once a year, there's another form that says, please send us something back saying you're still here, whether you do it online or by phone or by mail. They're going to send that out, and they expect to be responded to. It won't take too many times after that before they're going to send somebody out. So I have clients who live in Costa Rica. They just make sure the lady who watches their house, if they're not there, because if it comes in the middle of winter, they're probably not going to be there. So what we advise is if a person's gone a lot of the time to make sure when they're gone, make sure the lender knows. It's easy to tell the service things. They'll have a note in there so they don't freak out if you don't respond right away. And again, Social Security and Medicare benefits and other benefits will not change. So it is nothing. This is not income. It's not an asset, right? It's just availability of money. So you didn't change anything as far as your assets, only your liquidity. The equity in your house is actually attainable, and you don't have to sell the house or refinance it at a time. And it's not always easy to refinance when you really need it. That's the rule of banking, right? The people who really need the money can't get it. Well, this changes that rule because it's there no matter what. Property. So we're talking 1 to 4 units. So it's got to be again. That's what FHA. We follow the same rules they do. Manufactured homes. They got to be on their own land. After June of '76, they say double wide because we want to make sure. But I've done single wide, so it's doable. Just what's not doable is if they're leased land, right? So I mean, unless it's the 100-year lease, so that might be something we could work with. But I haven't done that. But it's in the guidelines. So, but I'm talking about where you're leasing it. You don't own the land. Though now, if it's a condo, because they could be a manufactured home condos. There's a few of them around here. I'm sure a couple of you have dealt with them or looked at them. I've done a couple. It's got to be FHA approved, and then we can land to one that is in a condominium, a manufactured home condominium, and or regular condos as well. Those also have to be FHA approved. So we have some other options when it's not approvable. We might have another lender who will do a reverse, just not FHA. But we got to get the FHA approval. We do that at Fairway. We do the work. I just saw an email. I wasn't able to read it because I'm busy here, but there was an email about, I think we just reached a new record on how many condos we've gotten approved because we got a great department that handles that. It's pretty much all on us as long as you can connect us with the HOA or the management company. And I've had great luck getting those done. So go online, at the HUD condo approvals. Best place to look on those, and you can look up a property by the city it's in or the state, and you can see if it's on their list. Now sometimes it's on the list, but it says it expired, so that way they had their act together. They just didn't want to do the paperwork and it's easier to bring those ones up to speed. So, I would even say you could even, if you got a feel for what the HOA is like, even go under contract as long as it's subject to, because we have a very good track record of getting those converted to approvals, and then that's really all you need. So no matter what, I mean, anytime you're doing a loan, we gotta review the HOA, conventional, whatever. So for the most part, that's part of the deal anyway. So PUDs, again, there's no requirements on those. Townhouses, of course, if you're standalone condo or townhouse, you may not need FHA approval, right? So I always try to verify that as soon as possible. But even if they're in a condominium association, but they're standalone. And then if you want to be in a living trust, that's great. More power to you. It's a smart thing to do. I'm not sure why it's not available in Texas, but right now I probably will be doing loans in Texas because I got family down there now. So it's a pretty big market. It's good to work in. And but yeah, living trust. So we do need to review the trust paperwork, right? And there's a lot of people, especially with Medicaid, and if they're planning for Medicaid or the potential for one of them to be in a long-term care situation, really smart to do. Especially you could set up a trust that there's a way to set up trusts that protect the house from one or the other of the spouses. So anyway, definitely. So I've got a few people on my team that specialize in that type of law. So I highly recommend at least looking at it when we're doing some estate planning. And then we have a thing why we say the maximum allowed home value this year $1,209,750. That is, it's changed every year. I don't know, I'm going back as far as I can recall. This is specific to the country, right? It's it's not just like by county like other FHA approvals are with reverses. It's 1 month, whether it's single, two, three, or four units. It's still that limited to that amount. So, and what that means is that's the value we're good when we're talking about. We're calculating how much you can borrow. We're taking the value up to that amount, and the age of the youngest borrower and the current interest rate, which changes every week. So yeah, so that those variables are there, and so you could have a $1.5 million house, and that's fine. But what we can lend is based on the $1.2 million limit. So there's not, and every year it's been going up. We'll know before the end of this year what it's going to be next year, and then we'll start lending on that right away. So if it goes up to 1.3, as I'm sure the values have not been going up as fast this last year, so it may not be up. It's been about 100,000 a year. It's been going up lately. So if it goes up to 1.3, that just means a higher percentage of the equity of the house you can borrow. And there are products that go up to 4 million. It's just not this one. So those are some good options too. All right. Again, a little overview of make sure uh, if we missed anything. So FHA administers the home equity conversion mortgage. So they're the boss, right? So if you want your loan insured, you follow the guidelines, or FHA won't insure it. So we have to be sticklers for certain rules, and most of that has to do with protection of the consumer, the borrower, the homeowner, and some has to do with FHA's guidelines. But definitely those also have to be met, or the loan isn't insured. And who would want to own a loan that you're responsible for, and but you don't get any payments for maybe 30 years, or more, 40? How long are people going to live nowadays? So, um, you don't get a payment, and so now there's lenders that'll do that because every loan gets sold. So people will ask me sometimes, how do you do that? Wait a minute, what's the scam here? Well, it's simple. Every loan gets sold, and that's how we get paid. Our loan, we sell our loan. Somebody else is going to be the servicer. They're going to hang on to it. They feel pretty good about the interest rates that they're receiving on that. They receive it eventually when the house closes. No matter what, when the house sells, they're going to get paid everything they invested and all the interest that is owed to them, because even if the borrower, even if there's not enough equity in the house, then FHA pays the difference. So, the lenders are going to get. So if I'm a long-term investor, it's a pretty good investment. I'm just not somebody who could put a bunch of money aside and not get paid on it for, who knows how many years. Who knows what people, now there is a drop date on these, and that's on your 150th birthday. So on your 150th birthday, the loan is due, and we don't have it's not forever. So as I tell my clients, if we get to that point and you're there and you want to talk about your reverse mortgage, give me a call. We'll probably be able to refinance you or something. And hopefully I'm still around too. If you are, maybe I will be too. Who knows? But anyway, it's a hope. I always say, yeah, I'll refinance you. Don't worry about it. All right. So again, the reverse mortgage is due and payable when none of the homeowners are residing in the home as their primary residence. So that means if a spouse goes into, doesn't matter who's got the income, right? Once you're approved, you're approved. We don't look at you again. We don't look at your income. We don't look at your credit. We don't look at the home value until it's ready to be looked at, because you're going to be selling, right? So there's no reason to look at it. And once you get to 100%, again, FHA takes over the servicing, so they're more set up and ready to take care of it when it is needed. But yeah, otherwise, it's due and payable when none of the homeowners are residing in the home as their primary residence. If you both moved out, you want to let them know so you can start making arrangements to have somebody. Now, again, so I'm sure y'all know occupancy fraud is the number one highest form of fraud. Hey, we just had who was it? Somebody in the government just got, oh yeah, a member of the Fed, right? uh, got got is getting jumped on for lying about occupancy. That's a whole nother story. But But in this case, some people probably would probably do that, right? So that's why they check once a year to make sure you live there because they're not getting payment. You know, the average person, maybe they were used to own the house, or maybe they bought the house and they moved out. It doesn't matter. That's not a rule for that mortgage, and they really don't worry about you too much because you're making a payment every month. On a reverse, they might not hear for you for from 20 years, right? Except for that once a year when you say, "Yeah, I'm still here." Um, so so that's why it's important to make sure your clients are truly planning on living there. We don't want to be a part of that. So, and then how do the adjustable rate for those who want to recap on adjustable rates? Now they're based, all of them are based on there's a index and there's a margin. And so the index is a thing that changes every day or every week or every month, depending on the program. And the margin, I like to call the profit margin, right? Because the higher the margin, that's more, the higher part of your loan is going to the lender, right? I mean, they have to charge something on it. So that would be a higher interest rate. So I've actually seen in reverses, sometimes people going for a higher margin, a higher rate, which still goes against my grain of so many years of doing, regular loans, but it's because that means their line of credit will grow faster. So a person who doesn't owe very much on their house and takes a higher rate, and that means the rest of their approved amount that is increasing at a higher amount because you have both your interest rate. So on a reverse mortgage, you have your index, which is the constant maturity treasury index. Used to be the LIBOR, right? They changed that a couple years ago. And this is an index, so it's a average of several treasury indexes, and and then that you take that of plus your margin, which again might be right now we're mostly around 2.25, 2.5 on the margin. So if you have 4%, brings you to 6.5%, or 6.25 to 6.5. And then there's also a mortgage insurance of 0.5%. So that's based on the balance that you owe. So 6% becomes 6.5% of growth in the line of credit. The line of credit is growing that much. Whatever you don't owe is growing, right? That's what I guess that'd be the saying. What you don't owe will grow. Um, but now, of course, what you do owe will grow too, as well, right? So it's just two different things. One is access to more of your equity, and one is access to less of your equity, right? So here's how we look at this as a tool, so that because a lot of people have a certain idea of what it's what retirement looks like, right? They're thinking about their future, and maybe they have a financial planner. A lot of the financial planners that are getting trained nowadays are learning about reverse mortgages and understand them better. Actually, some of the people we learn from are financial planners that have written books on reverse mortgages, which I've got copies of for those later that would like some additional information. So this is how we look at it. So pre-retirement, you got your pre-retirement wallet and you got your post-retirement wallet. Now, obviously, we're talking about when do you retire. That's a kind of a now those of us in mortgage and real estate, I don't know. I think it's not a quick, hey, here's your gold watch, here's your day you retired. It's more like we don't retire, we just fade away, right? We just don't renew our license. Uh, we just start giving out referrals and doing less ourselves, maybe. But it's still this applies to everybody, really. You got two times. So pre-retirement is when you're out there trying to make as much money as you can, trying to take care of your family, trying to live the best life you can, and hopefully putting some money away for the future. And what's that saying? Dear Lord, just let me make some money during this next boom, and I promise to save some. So because a lot of people in our businesses have gone through some pretty boom times, and maybe a lot of us are just making up for lost time, but also making up for lost savings is another good idea. So yeah, some of your money, of course, that you get from your bucket number one, your monthly income, is going to go into a nest egg. We're hoping, whether it's 401ks or IRAs or stocks and bonds, mutual funds, life insurance policies, that cash value life insurance policies, savings maybe some CDs. CDs were a lot better the last couple of years uh, for short-term savings, shorter long-term, right? So then you got what's left. Well, probably, as we know, a good third at least. In a lot of cases nowadays, it's about half is going into your home, your bucket three, which is your home equity. So you put your down payment, you put your monthly payments you're making every month, and then the maintenance stuff. I just put a new roof on my house, so that was a chunk, right? So you got all these expenses that you're going through, and hopefully you're building equity in your house. So some people, their bucket two is their bucket three. That is their nest egg, their house, right? And hopefully you've got both, but not always. And that doesn't mean that you can't. If it's your bucket three, is it something you're just going to wait to the last resort? You got nothing left, so now it's time to figure out what to do with the house. That might not be the best time to do it. You might want to do it ahead of time, continue building that nest egg because it's a growing line of credit. And then when it's time to either sell or borrow money, you got it available right away. So you see, in retirement age, so now you got less money probably coming in as W-2 wages. Maybe you got a pension, hopefully, and some continued income for work. And I tell you, a lot of the reverses I do, people got their Social Security, they got maybe a small pension. Some are still working. The ones that are still working, I always say, you could still, if you're still feeling good about it, you could make some payments on that reverse because it's going to decrease the amount you owe and just increase the amount that you have available to you. But you don't have to ever make a payment. So now people are starting to pull money out of their nest egg. So whether it's a set up an annuity or they've got cash value from their life insurance, they can pull money out, without paying taxes on it, things like that. But sometimes you want to save some of that. So a lot of people are like, well, my kids want, I want to save my house for my kids because they want they want the house. So do they really? Do they really want your house? Because most kids don't. They would like some money though. And so if that's the only way they get any money is by when you pass away, you leave them the house, they can sell the house and then they can all fight over the money then. Or they could pull money. Maybe they get written a big check out of your nest egg and there wasn't quite as much left in the house, but they really like that big check they got. That check spends a lot quicker and easier than waiting for the house to sell and figuring out how much is left. What it does is turn right now, well, man, you put all the money into this house, and we don't let you pull it out. Some people are having you pull it out for 9% lines of credit now or higher, and or you can always sell it, and then of course that's not the way to get your equity that you need right now, right? So the idea is leaving that as a third bucket of wealth. The less you have to take out of your nest egg, quite often you're also going to pay less in taxes because that's income. The money you pull out there is typically included as income, whereas the money you pull from reverse is not. So that could be good for even when you're making good money, there's still the tax uh, aspect of it. So as I mentioned, this is kind of an example. It's not meant to be any one person. It's been around for a while. It just occurred to me that it fit my mom's situation because she's living up there in Fairway and she had a $500,000 house she had bought with her sister, and her sister passed away. And then she was so there for a while. And it's getting to be too much house, so she thought she'd downsize. So I referred them to my friends who got sold the house for her. She was very happy. They were happy. And she ended up, roughly, she got a good chunk of cash, not this much, but it's roughly the situation. She had a loan against it. It sold for around 500,000. She got around 300. I think it was less than that in cash. And so she's feeling good. Well, she had things to pay, so she paid, and she took care of things and took care of a lot of things and spent money and rented and paid money on rent, right? And so even though she had a pension, and so she knew she was going to be okay. She could pay rent out of her pension and out of her Social Security a pretty good amount. She worked at Boeing, had pretty good retirement, but gradually she went through the money that she had over the years, and because that was 15 years ago, right? So when she ran out of money, she's paying rent. That's fine. She still got money for rent. But if she needed something bigger than that, then luckily I was there and I was able to help her out with that. Things she needed. I mean, for instance, moving to a new rental, she needed to have money for first last deposit, and She had some stuff. Her credit wasn't that great because when she was managing her own credit stuff, it wasn't always perfect. So, yeah, so it was harder and harder to find her places. And so, but we did, we always did, and got her moved and all that. So she lived, she had a good life all the way to the end, but it was a lot of work and not as more stressful than it could have been had she just bought a new home, downsized at the time. She could easily got something for 350 back then. That would have been a good fit for her, probably closer to me, I imagine, or meaning her grandkids, and then she'd have been in great shape, a good house that was better fit for her, and she still only had to put about half the money down, and she'd also have a big chunk of money to put in her investment. So she still would have had good money to put in investment, not have to pay anything for her housing expense except for taxes and insurance, which we would have been able to decrease based on where her income was. Because once you're a senior in every county in Washington State, but especially our big 4 or 5 here, you can do a reduction on your taxes once you're over 62, and if your income is below a certain amount. I think King County is the highest one right now. But anyway, so she'd been in good shape, but I can learn from my mistakes. That's half the fun of doing this job because when we make mistakes, we've got we can learn from it. So let's see. We got okay. Oh, we're close enough. Let me just tell this quick story, then we can take another break. So real quick. So this is a referral from a real estate agent to another loan officer who came to me. She was trying to sell her house. In this case, this is the same numbers but different story. But my story is more local. This guy was on he was on Beacon Hill, and he had an older house that needed work and he was going to have to spend some money to get it sold, and he's going to and get himself moved. He had a bunch of kids living there. The house was too big, the maintenance was too high, and he wanted to get out of there, and he always had kids and grandkids coming by to basically hang out. Maybe they're making him dinner, maybe they're just showing up and hanging out. There's usually somebody staying there. At least one of his rooms was full of storage stuff for another one of his kids. And his complaint to me when I got there was that these kids, they come by, they want to live in my house and stay in my house and eat up my food. And they never help me mow the lawn or do the gutters when they need it, or all the house is starting to, he was older. He was later 80s. He was getting a little old to be able to take care of some of this stuff. And so excuse me, here's Shelly coming back in, right? Yep. So he could wasn't getting up on ladders and stuff like that. So what he but he did not want. He was really proud because he had bought this house for a lot less, paid it off, watched it grow in value, and he felt really good about that, and he's really proud. And he wasn't going to downsize because the agent wanted him to downsize. Then we could easily do it, transition over to another house, and it'd be easy. And he just refused to downsize because he wanted at least as nice of a house as he had. He wanted to take a step back. So what we ended up doing, we set him up for a reverse mortgage. We got him a new. It wasn't actually brand new, but it had been flipped and been fixed up nice. A little smaller house. Actually had an ADU in it, and that way he had the option when one of his family members needed to stay somewhere. He had the ADU for him to stay in. He had his main house. You still have family over for dinner and whatever. And he was up more in Skyway area where he had more stores closer to him, and it's easier to live. So just a much, and he had a ton of money. He was able to put a bunch of money because he did the reverse, and that he was able to help his kids and grandkids as he needed to, and do what he wanted to do. So really, the flexibility was huge, and I mean, he was already taking care of his kids and grandkids as most people are. So it's kind of like you can give to him now, or give to him later. How about we do it while we're still here? So. With that, I think it's time for our 10-minute break. Straight up. Look at that. Okay. I'll see you guys at 12:10. So I do believe. I believe we're back on, huh? So let's see. Still good for my clock. All right. Gotta be close. So I wanted to check if anybody has any questions at this point.
Mike, this is Pam again.
Hi,
I
Pam.
just, I was just thinking, do you do a reverse mortgage on, say, like a boathouse, those beautiful ones that you see tied up, or big yachts?
Right? No.
No. Okay.
I wish now I'd love to say you had a house with a lot of equity.
Okay.
Right?
Thanks.
You borrow the money with a reverse there and pay
Okay.
cash for your boat or your whatever.
Okay, great. Thank
Right?
you.
You bet. You bet. And that's another useful use of these. I actually have a bunch of yacht salesmen that I reach out to on a regular basis because um, makes a lot of sense. You're sitting there in that $3 billion house looking out the water, see these people with these yachts going by. Wish I could get that one of those. Well, maybe they could. They do a reverse, pay for it in cash, and then they can drive their yacht. And then as long as they let them show up at home on a regular basis, I mean, they got, maybe they downsize. I don't know. But that's my idea of a good time. So yeah, I haven't heard they don't have a reverse on motorhomes either. But again, you can sure buy one by using your reverse, and you could be traveling around the country as long as you make sure you're home part of the time. So that's a good one. What else we got? Anything come to mind you've been thinking about? Okay, because I got plenty to talk about. So just want to make sure I respond to any questions you might have. All right. I'll say so. And it kind of so I told you the different story, and but the one you got it should have in your package as well as the one that we got here about Cindy. Again, it's similar circumstance. The idea, you got a house, you sell it, and you can pretty much just get to a similar house, especially you have paid off house. So many people, and a lot of people have paid off houses, and that puts you in a position where you could turn around and buy another. Now you might just buy with so. Uh, um, I get a good example. I have a client right now who has a small loan you just pretty much pay off if they wanted to, and they want to buy another house, and they could pay cash. Well, if we're in a circumstance where you could buy with a reverse, then that means that's going to be acquisition indebtedness. The money used for the reverse, that interest you paying on that is tax deductible, right? As well as it has to do with the money you're say if you finance, the mortgage insurance, something like that. So um, it makes tax. So you could purchase a house even if you have cash. You purchase a house with a reverse mortgage. You got your financing. The house is protected, and you didn't have to bring all that money in to closing. Some people think they'll just buy cash because I mean sometimes you can negotiate a better deal, quite often with cash, and you can turn around and then get your reverse mortgage, or again you could do it with it's even if you've got enough money to buy cash, but maybe you keep some of it put away and use the reverse for the remainder, and put you in a kind of a better situation. So, oh, let's go. Whatever I did something. I hate it when I do that. I don't know. I don't even know how to get. Oh, wait a minute. Wait a minute. I just draw on this accidentally. What happens if I do that? Oop, they were all drawings. Okay. Hey, I did it. Whatever that was. Maybe you didn't even see it. I don't know. Anyway, so let's talk a little bit about leverage when you're buying. So roughly, these are numbers that are more up to date than some of the older numbers we got, because what's happened over the years is FHA has changed the rules. And what they thought is, everybody's living so long, we need to lend them less money. So there was a time when we would lend a higher percentage of the equity to people, which meant they're more likely to turn upside down eventually, maybe 20 years later, maybe 30. So then they lowered the amount. Well, then what also happened after that is the interest rates went up. And again, that's a factor in how much we could lend. So when rates were in the twos, for fixed rates. We were down there with the basically it was just the margin. Say the margin's 2.25. That was the actual rate, because there was the index was zero. So that's when money was really cheap. I know it ended about 22. So that at that time, then when rates went up, the amount we could lend went down. On the bright side, the people who had a line of credit already, as when the interest rate went up on the line of credit, the amount of money that was growing faster, because it's based on your rate. Again, not what you owe and what you don't owe. So, but here's some numbers here. So we're talking about. So this is talking about maybe that's only lending about 35% if you get this as young as you can at 62. And it's a little bit higher than that right now, but that we want to give you kind of rough idea. Now, if you and then that's assuming you pay your closing costs as well, right? So again, your closing costs 2% can be another. I mean, it could be roughly 20-some thousand dollars. So that'll often be um, you know, we include that as when I've always told people how much they got to bring in, not just what the down payment is, and then you don't tell them their fees. So I also tell them the reserves if they're doing taxes and insurance reserves. In this case, you're not, but but these are good numbers because we can always do better, but we don't want to be worse, right? So 35%, we can borrow about 35% of 62, and then that goes up to 40%, 72, and 50% if you're 82, and then up even more when you get up to 90. So I've actually done a couple of these for people that are 100 years old, and it made sense for them because they were paying for in-home care. It was paying a lot of money, and allowed them to continue to live in their home for hopefully a long time, right? They look around at their relatives that lived up to about 105 or so. So yeah, and that's what the kids wanted. And both, I don't know why they would do it without talking to the kids, right? Something like that. But both times, yeah, that's what the kids wanted. So again, here's the advantages. For instance, with that example, $600,000 purchase. The money you're coming up with is the down payment, 120,000. If you got it, you might as well put 20% down. If you don't, you don't have to. But so that avoids the mortgage insurance, right? So that's so a traditional mortgage, you're paying 120,000 down plus your payment over the next 30 years. We're still calculating this in our example at 7.22. Hopefully, we're going to keep going down. We're down closer to 6 now, and we get into the fives. That'll be a lot of people advertise lower, but that's with points. So anyway, so this is showing what the amount of money you're coming up with is over a 30-year period, 1.469, $1,469,104. That's the amount of out of pocket money you come up with during retirement. Cash purchase, of course, it's just 600,000. That's it. Now you've tied up that 600,000 in your equity in your house, and what are you gonna do with it? If you just think, well, maybe someday I'll do something. Okay, well, if that's not necessarily a plan, right? But that is an option, right? So, and then there's our H for P, which is HECM for purchase, or home equity conversion mortgage, which is called a HECM for purchase. Again, we're doing this at 62, and then you're just coming up with your $385,800. Up front is your down payment, and that's it forever, right? As far as cash out of pocket, that's what we're talking about. So, so that's, you could be doing something else with that money if you have it. So another one of the benefits that we talk about is the coordinated strategy you could do with a reverse mortgage. And we use an example instead of just coming up with a theory. We went back to somebody who might have taken one out right before the 2000, right? Remember Y2K? A lot of people are worried what's going to happen with their lives. So in this case, my two guys, Hank and Bill, both were retiring from Boeing right before 2000, right? Because they were look, man, the whole world's going to go down. I want to get myself set up in retirement. So they went ahead and took retirement. They were old enough. They were 62. What the heck? And a couple of engineers from Boeing, and both making decent money. And they just decided, okay, let's just both do this. They have more time for fishing and hunting and the other stuff they like doing. So Hank went and talked to his financial planner before he did it. He said, "Yeah, that's sure good, but I tell you, you're retiring early. If you're liable to run out of money, you know, and because based on how much money you want to spend, the way your spending habits, looks like you want to get about 4,000 a month out of this thing. So let me show you what that looks like." So he showed him kind of the plan, what it looks like, and how he would be out of money probably before his next 20 years was up. So he said, I think you should talk to, got a friend who's a reverse mortgage specialist. He could kind of show you the numbers. So we talked back there in 1999 and pretending I knew about him back then. And I like to be the hero of the story here. So anyway, so he and his friend Bill, he said, "Hey, Bill, you should probably talk to this guy." He said, "No, no, my barber says those things are a scam. All right, I've talked to a couple people; those are a scam. You're just going to use up all your money. So I'm smarter than that. So good luck with that." So all right. So him and Bill just both wanted $4,000 a month to contribute. They both had pretty much the same lifestyle. So Hank, first thing happens is he's getting ready. He goes to his financial planner, and he's like, "Man, I tell you, the market's really down. I don't know. Now's time to take a bunch of money out. You might want to tap into that reverse mortgage." So he says, "All right." So he starts taking $4,000 draws from his reverse mortgage. He'd set up a reverse $500,000 house. He was able to get about 250,000 in line of credit. So we started taking out 4,000 a month. So years goes by, man, the market's hurt. The market's down about 9%, and his line of credit now he owes a bunch of money on this line of credit. He owes 48,000 plus the interest, 49 some, and not so far not thrilled. And I think Bill was making fun of him a little bit because he's losing his money from his reverse. And same thing happened in 2001, even worse. And then 2002 was even worse. So the rate of return was low. So he kept listening to his financial planner and said, "Look, just keep doing what you're doing. I'll let you know if it changes." So each year, 48,000 a year, he ended up at the end of 3 years, he owes 137,000. He's taken out. Excuse me, his line of credit is down to 137,000, and he's got a balance of 156 because of interest on his 144 he's pulled out so far. So next year, planner says, "You know what? I think you're probably good, man, to take some money, start taking some of this money, because you got to start drawing something eventually." And right now the market's doing great. So he turned that year, took out 5,000 a month because he had to pay taxes on that. And so he netted actually less than 4,000, but close enough. And he made sure to put aside his money for his taxes, so he'd be good. So he took that out all that year, and he kept at it during the 2003, 4, 5, 6. Forgot about his reverse mortgage. I don't need it. So that reverse continued to grow. Now, of course, the balance went up some because there's interest, but so did the line of credit. Excuse me. So then he got to 2008. We all remember 2008, what that was like. And again, he said, I know, I was probably take from my reverse. I'm not going to lock in the losses, blah, blah, blah. So he didn't lock in the losses of a bad year and came back to, again, taken back out of his IRA back in 2009, where he proceeded to just take money from his IRA, didn't worry about it, had a reverse mortgage. Yeah, the balance is going up. He didn't for now could be more creative and had made payments to that when things were going good. It would have stopped the balance from growing. The line of credit would continue to grow even more because there was not borrowing as much. But you can put every variable in there and eventually get too confusing. Let's keep it simple. So we made it all the way to 2018 when he went ahead and started pulling from a reverse for a bit because the market was down. He didn't know how much. Ends up not being as bad as he thought it would, and then went back to the great 2019 that did real well. So when he got to 2020, took a look back. They went back and looked at it, sat down and looked where they were, him and Bill, and he said, "Well, shoot, um, how you doing, Bill? I know I'm in pretty good shape. I got 912,000 left because I didn't take out during the downtimes, and I know I got this line of credit, but I still got a lot of equity. Our $500,000 houses are worth about 1.2 now, maybe more. So they're both in fair. That doesn't change how much your appreciation happens, whether you got a reverse or not, right? So he looked over at Bill, but said, "Well, Bill says, well, no, man, I know we didn't talk much the last couple of years. I've been broke for a while now. I ran out of money about in 2016, um, and I guess I did get a reverse mortgage. Turns out you were right. I got a reverse mortgage then, and I was able to. Now I've got some money to start borrowing, and I'm okay. Well." What they looked at is like, okay, so he got a reverse in the end. If he didn't, that means maybe he's selling his house, maybe he sold his house, maybe who knows what happened. Maybe he didn't pay his taxes on all the money he pulled out, and then he ends up with an IRS lien or something like that. So again, he started feeling broke because he's watching his retirement decline. He knew they're not going to have anything left. Maybe he sold his house and he's been renting this time. Who knows? Whatever he did, probably not going to let himself actually be broke by 2017 when he's got a paid off house. Find something to do. But if he did nothing, he ends up in a lot better position in that instead of having the IRA at 912,000, his was at zero and had been for a couple of years. He didn't have a line of credit because like Hank did, because Hank had already set up this line of credit, which kept growing even though he was taking a lot of money out, and he had a lot more funds over those last 3 years, which Bill didn't. And so even if we look at both liquidity, again, that's 1.27 million in liquid assets that Hank had during this process, and but even as far as even having liens against the house for 541,000 or money borrowed against it, he still had 521 more thousand in assets in general. So put him in a lot better position. And then again, who knows what happened to Bill when things started getting rough? I mean, say when he's broke, did some dumb things. Who knows? Maybe took some chances because didn't like losing money. Maybe he lost more money. If he even kept his house during all that time, he could have lost to the IRS, or maybe his wife left him. I mean, hate to suggest that, but it happens a lot. So the guy's not doing very well financially. So anyway, just imagine now. One of the great things about the reverse is the asset protection portion of it. So when you have a reverse mortgage, you actually have liens against the house that shows that according, if you look at the lien, you look at okay, here's the value, assessed value, and then you look over at the lien. There's two deeds of trust. Each one, and let's say a person has had $1 million home and said there's about $3 million in liens against the house. I've had agents tell me, Mike, how did they borrow this money? Because I look at the deed of trust and they owe more than it's worth, way more than it's worth. I can't believe that the FHA lets people do that. One of my friends is an FHA appraiser, and she came to me a couple times about that. I was telling her about reverses, and we should talk about it. She said, "No, I do appraisals for FHA. I see what it looks like, and these people they owe so much more than the house is worth." I said, "How do you know what they owe?" I said, "Well, it's public information." I said, "What the liens amounts are public information, but not the balance of their loan." That doesn't show on the credit report, doesn't show on the title, doesn't show anywhere. It shows on the statement they get every month, but that only goes to them. So the lender knows and they know, and it's nobody else's business. So the only way you can find out what they owe is by talking to the client and get a copy of their statement they get every month. That tells what their balance is, how much they got left to borrow, and how much they've spent, and so on. So yeah. So I've had other agents do the same thing. They want one friend of mine. She says, "Mike, I want to go talk to them about this, but I'm trying to figure out how much they owe." And I said, the only way to figure it out is to talk to them first, right? So I know you'd like to go out with your listing presentation and all that, but you talk to them first, see if you can get them to send you a copy or have them if they want to talk to me, maybe they're not comfortable. I'm happy to talk to them about in general their options, with the reverse and with selling and buying something else. So anyway, so that's generally one of the pluses of that. Nobody knows how much you owe. You could have a line of credit. You could have a $500,000 line of credit on $1 million home, and you only owe the 20 some thousand it took you to get it in the first place. And that's all you owe. Maybe you pay that off down to $100 because you got to have a little bit of a balance to keep it open. But they don't really care what you do. You you pay it down, or you sit there and accrue interest on 20,000, but you're increasing your line of credit by the interest rate times the total amount, so half a month. So there's 30,000 might be increasing, and so it goes from a $500,000 line of credit to 530 to 560 to roughly 590 or closer to 600. Just based on the interest rate. If rates go down to 2 or 3% again, which probably not, but then the interest is not going to grow as fast, but neither will the interest you're paying. So that's a pretty good place to put your money because it's pretty safe. And what kind of return are you getting on your money? And are you looking at Are you looking at your house as an asset that you can't take with you? So just keep that in mind. And you can look at it just a little bit different. And also the money you got there, all the way down to Medicaid is one of the tougher things, really, because you can't have more than about $2,000 in your bank account. And if you have too many assets, now your spouse can. There's ways to structure that with a trust where your spouse could have more assets. But so that's a whole nother game. And if you need help with, I got some attorneys who are very good at the whole Medicaid thing. But if you get to the point where your spouse is in a position where I had one client, and I know this isn't even the top of the line, but she was paying 15,000 a month out of her IRA to pay for her husband's memory care facility, and it wasn't even that great. And that's $15,000 that she's having to pull out every month to cover it from her IRA, and that means that's going to be taxable, and it's going to cost a lot more than that. So there's a lot of differences. Again, community spouse resource allowance that has to do with just how much of your assets can be in the in your spouse, but not your hands. So and then you're reducing your equity to keep you in a position where you don't have to sell your home. Again, I have a bankruptcy attorney that refers clients to me sometimes where they're thinking about filing bankruptcy. They got a paid off house. I'm like, he's like, yeah, no, you're going to have to sell your house if you file a Chapter 7, and so, and typically, like, if you're going to do the bankruptcy, you might want to wipe out your debt, not just have to pay it all back. And if you do, you don't want to put that into your house. So even that is some more options there. That's good to know, good to understand if you're working with people. And with the way the world's looking, and I'm hoping I'm wrong. I'm a pretty much of optimist, but we're going to see more people in tougher positions than we've seen since 2008, right? Hopefully not that bad, but there just seems to be setting things up for some sort of. I mean, hopefully the sky is rosy and everything's going to be wonderful. But could be opportunities for those of us who specialize in helping people when things are down. We'll be in a good position to help them when they are. But again, you don't want to be making decisions when things are bad. You want to make smart decisions when things are good, and so you're prepared for what may happen. So long-term care, again, you could have a person who's needs long-term care, but if they get a bunch of money in their bank, they're going to have to spend it down. So there's a thing with in our state, and there's a 5-year look back on any transfers you've made, and if you have made when you go to start using the money you can get from the state for long-term care planning, long-term care expenses. They start paying them for you. It doesn't mean it's free. It means they would hope to recapture that money someday. And if you got assets, they just might place a lien against them. Less likely when you have a reverse mortgage to get a lien placed against you. So, and again, you can prepare for things knowing what the rules are. So it's good to consult with an attorney. And same with the state tax planning. If let's hope because there's federal and state, and you want to make sure people are advised on that. These people who bought a house when it only cost 20,000 and now it's worth 2 million. That's they have other assets as well. I mean, they could be living in a state that could cost them some money, and so that's good to know. I'd rather give anybody but the IRS my money when I die, just personally. So so the long-term care is something we can help with, right? So because if you let's say let's say you've got a long-term care policy, and you've been paying on it for a while, but they still hit you, and actually premiums are going up. Well, you still have the opportunity to pay those if you've already spent the money, or maybe you have a life insurance policy that is also convertible to long-term care if you need it, and but you get to the point where you can't afford the payments, and so you let it go. Well, with you got a reverse mortgage, you can still afford those payments, and it's probably a good place to spend the money to keep the premiums going, so that you've got that insurance. Because especially after you paid into a while, it'd be a shame to let you go. You don't even do a lump sum from your reverse to sometimes without a lump sum they don't want to insure somebody for long-term care or for life insurance. So you can put some money into the thing, so then you're guaranteed for you in case of a need, or later your legacy within life insurance. So also some flexibility when it comes to Social Security. You got a reverse, you're able to you extend out the time until you start taking it, because you get more the longer you wait, the more you get. You got to do your own calculations on that, and we've been told specifically, as people in the mortgage industry, not to tell people to get a reverse mortgage and you get more Social Security. Reason being, they don't think it's worth it, straight across. We've got a couple of pretty well-known financial planners who have written articles on this, showing them they're wrong, right? So I'd like to share that information as well, get both sides. So I don't know that I would get a reverse if that was my only thing that was positive. So far, my wife says I should take it. That's enough for me. She's my expert. So, but we'll see how that goes. All right. So, life insurance again. People want to leave their home to their kids. If you're in a position to leave them to buy a policy, probably a better way to go. Get a life insurance policy. There's a lot of different. I'm not even going to go into the different options there. There's a lot of them. That's where you talk to. That's why I make sure I've got people I can trust that understand this stuff better than me, because mortgages is plenty. People who do real estate and mortgage, or mortgage and insurance, that's great. I don't know how you can juggle all those and be an expert in both, but I'm sure some people are smarter, I guess. And I believe in focusing as much as I can on what I do. So, but definitely going to leave behind a larger legacy if you're just leaving your money in your house, right? So, and life insurance could get tax-free payments to their heirs after you pass. So, some people. So this is kind of scary. I mean, I can relate to this, being about to be 62. So sure, I could be considered retired, um, if I'm not quite sure what I want to do as far as the reverse. Luckily, I'm not going to retire, right? But um, because you lose the insurance. I was on leave a few years ago I was in a major car accident, and so they put me on leave for a few months, and uh, 1 month longer than it, I guess, should have been for me to keep my insurance, because they've paused my insurance. So, and they said I know it was going to be $1,500 to do the Cobra thing for that 1 month, and so that just tells me what it would cost to continue insurance. And I told my family, let's just not go to the doctor this month. We made it through the month and got back underinsured again, and. But I don't know if that gap is kind of scary. So, what are you going to do during that time? Well, you could afford the insurance at least, so reverse could get through that period, or most people just keep working. At least one of them, right? So another one of the positives and strengths of reverse is the ability to lock in a certain value on your house and lock in the growth that can happen with it. So this is the idea. Say you got a $500,000 reverse on $1 million house, and you didn't use all the money, maybe you didn't need it, and so, but you've got a reverse mortgage that is, as I've said before, grows every month. So while your reverse is growing, and especially once it gets to a certain amount, why the arrow starts arching up faster is that interest compounds, not just interest that you pay, but interest you are receiving on when you've got a line of credit that has compounding interest, both on the money you spent and the money you haven't spent. So you can see, so you could have your house goes up maybe to 1.5 million, but by the time maybe 15 years later or so, your line of credit is up to 1.8 million. So what's that mean? Well, you don't have to move out, right? You know that probably FHA took over the servicing somewhere around when those lines intersect, but that doesn't mean they do anything. You know, as long as you're still in the home, you're paying your taxes and insurance, and you just keep letting that thing grow. And then at some point, if you want to, during that time, you can pull the money out and invest it in somewhere else, and then or give it to your kids or whatever you're planning on doing when you die. Who knows? And then meanwhile, yes. Oh no, now I owe this money. So what? It's just equity you don't have, and FHA has to pay a claim, which doesn't hurt anybody. Fact is, you paid that 2% up front. You pay a 0.5% per year of your balance. You pay plenty, right? So don't feel guilty if you end up taking out a bigger check than what your house is worth when you decide to. So that is an opportunity people have. Um, as we can lend more money, obviously it more often happen. It's the program is schedule is structured so that we don't have more people over than under, right? When they die, and the idea is when people die, half the people got more money out of their house than it was worth, and some people passed away. There was equity left, and so they don't have to pay a claim on those ones, and so that way it paid the claims. Are paid for by the fees that people pay. As far as tax implications, and again, I don't get too far into this because we're not CPAs, and it's not my expertise. I don't do my own taxes, so I've got somebody for that. So, but let's say you take out a $200,000 line of credit. You took it all out for maybe it was a purchase. Could have been a purchase. You could have paid off your purchase loan with it, and now you don't have a payment. So you're enjoying not having a payment. Year one, year two, maybe you're up to so you're up to because it's 5%, which again, most of our figures are assuming 5% or less. We've been higher for the last couple of years, but we're hoping. But all that means is more growth, more interest, and if it is higher than that, and more potential. So after a couple of years, you're 20,000. Well, at that point, you've got the option that if you wanted to in year two to say, okay, I'm going to go ahead and pay down that 20. Maybe you had a good year and you got a lot of expenses. You're going to pay a bunch of taxes. So say, how about I get a $20,000 deduction? That might be worth it. Maybe year three, it's a $30,000 deduction that you're looking at. You spend that 30,000 or 20,000, and do what you're gonna with it, and but it doesn't matter because you paid it down when you paid down that balance to 200,000. So you get to write off that 20,000 in interest. So if it's 30,000, 40, whatever, depending on how much interest has accrued. So you pay off principal, doesn't there's no tax benefit to that, but any interest that is accrued, you're able to write that off. You get a 1098 form for the interest to get to deduct, and at that point you've paid down your balance to that 200, and you get that $20,000 write-off. So if you want, that line of credit is available now. You can turn around and borrow it back out, reinvest it somewhere else. But because you've made enough money, you needed the write-off, you go ahead and take it that year. You don't get to write off interest when you make payments. If you don't make payments, excuse me, because you only get the write-off when you make the payments. So you can not make payments for 2-3 years. It makes more sense, really, from a tax basis, to not make the payments for a couple of years. Just let it sit there, and until you have a strong year, the stronger year where you want more of a deduction, then you take it that year, and then you're able to again. There's a net zero cost because you're able to pull that money back out as long as you're flexible, got the liquidity. which liquidity is part of why we're doing reverse mortgages in the first place. Get the liquidity to come with money. I mean, I've always big on liquidity because you never know when an opportunity is going to arise that you want to have some money for. So now again, this is an interest. So with tax planning, we got a whole section on that. That's really not part of my part of this gig. I'd like to focus a little bit more on the purchase aspect of it, but I want to make sure you have all this information anyway. Um, and again, paying the interest at the same year you take IRA withdrawals. It's how you offset the some of the money you're paying in taxes. So that's really what it comes down to. And there's different variations on that aspect of the fact that now think about it. There's another. The fact is with taxes is it's right now the way the rules are. I mean, I know they added this year that you can mortgage insurance is tax deductible, and they've changed some of the guidelines on the insurance, who gets taxed what. And I'm sure not going to try to make sense of all that, but because they really don't even know. They really don't know till the end of the year. You know, a lot of the CPAs they really can't figure it out. They got ideas, they got guesses, but they really don't know for sure till IRS sets all the rules and they start filing taxes. But there's some real benefits to buying a house with a reverse mortgage, and one of them is that it's a great way to get into a 55 plus community because again, if it's a nicer one you might normally be buying, you can do that with a reverse. And again, if it's a place that has a HOA, it may or may not be a factor, and if it is, we can still help you with that too. So, and then the fact is, so for the purchase for interest to be tax deductible, right now, my understanding is that it has to be acquisition indebtedness. So that means it has to have been money used, a loan that was used to buy a house, or to pay off a loan that was used to buy a house, or it needs to be from a construction loan or a loan used to remodel the home. Meaning you got to show that you actually spent the money on fixing your house. Those forms that the lender sends in, they've now got they talk about when you took out the money that you're writing off your interest from. So again, I'm not no CPA, but I know that. So that's how I talk to clients about it, is when it's used to buy or fix up your house, that is got more liable to be uh, able to get a tax deduction for it. So that's another good reason why don't just refinance your house into reverse, but you probably do, especially when houses. So I deal sometimes with people who are hoarders, and so that's the best way to help a hoarder. Well, let's just sell that house. Let's get somebody in there, fix up your house, make it a little bit nicer so we can sell it for more. But pretty much as is just fine. Plenty of people will do the work themselves, and they're probably gonna get it done cheaper than we will because they're doing it themselves, and they'd love to do the work and can work out a deal. Some of the agents I know have their own estate sales business just to for that purpose, and now they get them on to buying another house. I mean, we've even got some programs. I mean, a reverse won't do this necessarily. You can't do a bridge loan and a reverse. It's one thing to know. They won't let you borrow your down payment money. It has to come from the sale, which you can do a bridge loan even from the sale to do the sale, right? And then when but we can't use that, as part of our transaction, right? So, but so yeah, so the money has to come from a sale or from a gift or from your savings, something. So, but still, allows you to fix up the house. They could buy the other house, while once they've closed on the first one, the same day, right? So, so that then they've got the acquisition indebtedness, which is they're going to have for their interest they pay. So again, there's never going to be mortgage payments. That's a good thing about buying a house with a reverse. Often it's to get closer to family or better weather. That's why I got approved to do loans in Arizona. Probably going to add Texas and California. And I've got other people in every other state, so I can always get those done. And then, but just a more appropriate home, especially one that has the one story aspect. Manufactured homes are great for those. They're not only they're a little less expensive, but they're set up pretty good for somebody who's gonna as we age. and purchasing a home. Again, 30-50%. I'm sorry, it's more like 50 to 70% now, right now, as far as you're going to putting down. And we can close. So the big thing is we can close these. So reverses are just as easy, actually easier. They're easier to qualify. There's no payment, right? And we don't have, there's no credit scores. We look at the borrower, do common sense underwriting. It's a real person, and we just got to follow FHA's guidelines. And FHA is usually pretty flexible. So, if we get an excuse, meaning somebody had some credit problems, but it was not their fault, right? Well, if we can explain that and prove it to some degree to the underwriter, then we can even get the loan done and with no extra limitations. And even if we can't, we still can do a loan, but it's got what's called a life expectancy set aside, which I'll get into a little bit later. But a life expectancy set aside, or LISA, is where we put the money as part of the line of credit. We take a portion of the life expectancy of their taxes are going to be and their insurance, and put aside that amount, and we pay it for them when it comes due. So it's not like a escrow account. It's an account that just limits how much you can borrow. It all sits in your equity. It's still your equity, and we just pull a little bit out of your line of credit as we go. So it's not a big, it's a big chunk less that you get. So most people would rather have the money than have their taxes and insurance paid. But some people sign up for it that way. So, excuse me. All right. So again, up to 6% of the sales price is available to pay closing costs. So that means we can, so there's really no costs, and it's just their down payment. And that's if the seller, maybe a new construction is a good time for that. The seller, because now the builder can actually raise the price, which kind of affects all the houses in their development. And maybe they do a little extra for it. Maybe they're just paying the closing costs. And because a lot of times I've had builders where we got seniors, so we got to do a few things to make the house more senior friendly. Stairs seem to be the biggest one for me. Sometimes wider doorways for wheelchairs and stuff, or the bathtubs obviously are a big one. And yeah, so depending on the circumstances. So it's nice to have all those things covered by the seller if we can. Now, and that didn't used to be the case. So if you hear it's not the case, then Mike's wrong. Nope, I'm right. Just didn't used to be the case. Used to be I used to have to tell everybody you can't include any of the costs for being paid by the seller or the agent. And I've even had an agent try to do this at closing. I said, no, that's not going to work. But now it's not a rule anymore. The seller, they figure there's enough room in these deals where the seller can, cover closing costs, which does kind of lowers the down payment amount a little bit, up to 6%. And then I mentioned before about the appraisal. Again, that's you got to know that. So whether you're listing and somebody else comes in with their reverse mortgage approval, you got to remember that later they're going to ask for that. They may ask for a second appraisal. So you're not just because the appraisal's in and everything's fine. Most people don't have a form that says, "Oh, by the way, here's the second appraisal," and it's fine too, hopefully. So it's something to know. Another thing to know is that the underwriter, if your contract states there's going to be an inspection, the underwriter wants to see that inspection. That's been the rule forever, right? For on reverses. So the underwriter wants to make sure that there's no safety issues on the house. So, which that's probably good. You want to make sure there's no safety issues on the house too. However, I prefer not to have the two people most likely to screw up the deal, working together against us, right? Which would be the underwriter and the home inspector. I mean, they're great people, but they have a different agenda, right? And so, my thought is there's a way around that, which we typically will use, where we'll say whatever you do with the inspection, whether it's a pre-inspection or it's an inspection you did, and negotiated some deal. Now we can actually negotiate closing costs. So, whatever you negotiate, we would like to see a waive that inspection, and some people will tell me, "Oh, you can't do that." So I'm not telling you you're the expert on contracts and all that. I just telling you we're either going to have to look at it or have it waived. So however you guys want to go about this, I'm here to help, right? So Another couple things. A certified reverse mortgage specialist. There's a reason why that's a big deal. I forgot who was what it said earlier. Said don't get somebody doing a reverse that doesn't know what they're doing, because your average loan officer now, even we have a whole week long course that somebody takes that want to get certified. Well, it used to be in person, and we do it. We go away to another state or area and do it. I did it a couple times before I really got into reverse, because it's a week long training. Now I know we're doing online now, which it's great for real estate classes, but teaching somebody about reverse mortgage, I don't, it's not, they don't come out knowing near as much. Okay. Same with my online first time home buyers. All of a sudden we get into contract. I'm like, we told you in the class not to do that. Well, when I'm face to face, they get it better, right? Things like don't go out and buy a new car. Don't get a don't get a new credit card. Pay your bills on time. Don't get in an argument and don't lawsuit somebody right now. Anyway, um, don't quit your job. All those things that we've been telling people our whole careers. And anyway, the online teachers don't have don't get through as much, right? Somebody's probably not paying attention right now. Anyway, so here's what's important. A certified reverse mortgage specialist, somebody who understands reverse mortgages, isn't going to tell people stuff that's wrong. Those I get more referrals from other loan officers than anything, and I'm more likely to have them tell people wrong stuff before they reach me. So, and that's just because they don't understand, but they know they're an expert on mortgages, but they're not reverse service. So Fairway, we're pretty good. We they do a referral program where you get actually paid a referral fee to refer it over to a specialist. So I can't cross referral fees from other places, but I still get referrals. People just don't want to deal with them. Um, and then the loan officer not only should be reverse mortgage specialized, but also understand the purchase business. If we're doing a purchase, the guy who works in a call center back in Omaha or wherever, or Oklahoma, um, and is pretty good and understands these things. Really good at selling them too, even if they're only telling half the truth. But do they understand working with realtors? Do you understand you gotta return their calls even on weekends and evenings, and that's when people buy houses is on weekends. So you better be available with a pre-approval letter, whatever. Um, they're not used to that. So there are not many in those big companies where doing a lot of advertising, not so much. Most of you probably work with somebody who does that. That's why you're working with them, and they probably have. If they're not a specialist, they have one with their company. So yeah, Fairway's really good, and so there's plenty of other companies out there that have taken on reverse mortgages in the last couple of years because they need to fill that void they used to have with refinances. That's pretty much not part of our lives. If there's not a divorce or a death or a major problem, why would you get a refinance? Why give up your 2.5 for a 6%? Not many people doing that these days, right? So the ones I see are people that they never were able to take advantage of the real low interest rates and have a grown, but now they paid it down so much they're paying mostly principal anyway. So anyway, uh, so that's why you see a lot more reverse mortgage people. Mainly, not that it's easier because it's not, or not that it's well, I think it's more fun because I like the people, but um, yeah, because they need to do something to get some more business aside calling you up and saying, "Hey, how'd you like to have a cup of coffee?" Which I'm sure they're friendly as well. But anyway, so, new construction as a building is a great opportunity for you. Most new construction don't really have set up a reverse mortgage program, and if they got somebody at the who's showing the houses, they don't have that as an option. And a lot of times, especially if you see houses that are built 55 and older places, or where you got more ramblers, or some stairs aren't that nasty. Um, and there's ways around it too. So, but yeah, so the fact is we could have a pre-qualification. They could be qualified. Closing as quick as we want to isn't always as easy because we can't get that. They have to, sometimes if they're sitting there and they got the occupancy cert, all we got to do is clear our appraisal. That's fine, but we can't get the appraisal till they're under contract. So that's about the only thing that slows us a day or two. but you got more people that could qualify. A lot of people like a brand new house. It's just that is there anything under 800,000? Well, maybe somebody who can afford 400,000 with a reverse can afford 800,000. So that allows more of our buyers to qualify. If you got somebody who just can't quite afford what they really want, and they're over 62, it's at least an option we can show them. Yeah, increase your sales. Again, it's you're talking to somebody. Most people don't understand them. I mean, if all the people I've taught in the classes, a lot of folks come back, and or at least we have other conversations later, which I highly recommend. And but yeah, upgrades are great because we're gonna lend a certain amount based on the price, and as long as the appraisal supports it, now those upgrades are financed in. So and then the other houses, with or without the upgrades, have kind of shown themselves to be of more value because of of the comp. So yeah, so great way to build some relationships, show people stuff they don't know. I mentioned earlier I was going to share a little bit about the financial assessment aspect and the LISA. So again, we look at residual income, not we look at residual income, not debt to income ratios. Right? Normally, hey, you can't have more than you got. Let's say you make $5,000, all your payments can't be more than 2,500, right? Because 50% debt to income ratio is kind of a standard. It used to be 28%, right? So 28 and 36 were the numbers, front and back ratio. For years now, it's been roughly 50, even you go higher sometimes. We don't have a ratio on reverses. But we do look at, there's got to be some money left over. You got to be able to have some food with your meals, and other things. We want to know you got some money left over for expenses, and every area has a different residual income limitation. So we're going to take your payments for your taxes and insurance and other bills that you're paying, and then we're going to do a certain amount that also has to be there to cover your living expenses. And once that's there, we can qualify you. We can use the reverse as a qualifier. That money you're going to get from the reverse is we don't have to count the mortgage you have now if you have one, because that's going away, and we can count the reverse as income, which we do, or assets we can count as income. We call it a spend down. It doesn't mean you have to spend it down. It means we're calculating a spend down on your assets to qualify you for being able to afford it. So it's a lot easier to afford than other loans. And again, we've got the biggest thing we really look at that people aren't always aware of is your property charge history. So do you pay your taxes on time? A lot of people have free and clear houses. Sometimes they forget about April and October, and they don't pay their taxes on time, and then we can't afford them without a LISA, right? Without a set aside. So really a good idea to double check, make sure those taxes and insurance are paid right first beginning of the conversation about this, because you might need to show some time where they are paid on time before we can maximize the reverse we can do. So that means taxes, insurance. That also means HOA dues. So that's gonna be now. Sometimes there's a beef with the HOA. I just closed one like that. We were able to get her the house, and she had a big thing going on. She wouldn't pay them, and they wouldn't, they filed a lien against her. All this. We ended up getting the reverse, but I think she needed a Lisa because she'd been, got so far. But um, so that's an aspect. That's really what they're talking about. The property charge history is your taxes, your insurance, and your homeowners association, and then your general credit history. We do want to see, at least for the last couple of years, you've been paying bills on time. Again, otherwise we need a understanding of why that was. And in that case, you don't need a set aside. And otherwise, if you do, you will need one. They talk about a partially funded one. That doesn't happen very often. It's either yes or no, but it is an option. FHA allows. I just don't see lenders doing that. Sometimes I wish they would, but we still. By the way, we shop around. We got different lenders, a different servicer who's going to be taking the loan on, and there's different secondary market people who underwrite slightly differently. So one thing we do, and other lenders, I'm sure, we have several options. So we service some ourselves. We service both. Usually we're selling the loan to somebody else, and we're going to look at if it doesn't go one place, we'll try another underwriter. We get more than one shot at this. So again, downsizing. great opportunity where a person could downsize and get another house where they're closer. I kind of this is different person, same story, right? This is Cindy and doing a similar thing again. So I have friends that sold their house for 1.5 million in Maple Valley, and I think they bought some for 375,000, which is bigger and nicer over in that was in Tennessee. So a lot of people will leave, and boy, it's sure amazing what the difference is in some places. Um, and that's always another option if somebody just can't get what they're looking for. Again, some people might just upsize and go for a little more house, maybe, or maybe you got two couples or a couple getting together and they want a nicer house, but with the reverse and with the money they're able to bring to the table, might make sense. This is an example. Say he's got a paid off house and he continue living there. It's worth 373 600, or putting that money down and getting a $600,000 house. Just means either nicer, or in a nicer area, or for whatever amenities they not need. I know I moved from Vashon to Tacoma. I was able to downsize. It was great. Then now my wife and I were probably going to upsize a little to a different area. Really, she really wants waterfront, and so do I. We got dogs, little puppies that we really want to watch them run into the lake and swim around. So it sounds fun. Anyway, and crime. So I've had a few cars stolen, stuff like that. Not just in Tacoma. Love Tacoma. That's why I moved there. But I had a moat when I lived on Vashon. A lot less happening to you there. So I think it's important. I always would like to talk about the oh shoot, look at me. I got over my time. I don't want to take up any of your time. You guys thank you for being here. I am here still to answer questions. I can also share what I talk about the silver. If you ever want to have a conversation about silver superheroes, it's a networking group I put together. The people who focus on helping seniors. I'm putting a lot of energy into that because I can do my job. Doesn't matter if they don't have a good realtor, good attorney. Somebody handling their Medicare, the Medicaid, all the different aspects, a contractor to help them fix up the house, both either the one they're in or when they're going in. So I stay in my lane, and then I refer to people who do their jobs, right? So let's see. I think I have a list. So this kind of idea. Some of the people that I'm looking to fill these. What we do is we put together power teams. So I got to have a realtor in any team. Got to hopefully it's a senior real estate specialist, but a lot of your specialists just haven't gotten that little designation. That's just fine. Got to have me because it's my thing. No, got to have a reverse mortgage planner, somebody who can at least talk about that option, and this is why I'm doing it. I mean, I do plan on continuing to do business. I've got a couple other planners that work with me as well as assistants, so it doesn't have to be me. But Power Team is going to have somebody there, somebody to talk about Medicare. Doesn't have to be one in every team, but at least one access to somebody who can talk to people about the Medicare. People think they have the best plan, and they're often wrong, right? So they can save some money here and there. Sometimes it's how much, a couple $100 here and there really makes a difference. Same with Medicaid, you really got to plan for that ahead of time if it's something you're going to need. Same with reverse mortgage, man. Especially I do a lot with the Alzheimer's groups. If you've got a spouse that is not going to be able to sign, we better get that handled, get a power of attorney while they can still handle it. Otherwise, it's you got to go to court to be able to do something with them. So, again, financial planners are real important. If you got money, let's figure out the best place to put it. Make sure they can also back up the idea that if they don't like reverse mortgages, that's cool. Let's have a conversation because I could probably show them where it's going to help their clients. A lot of times we deal with probate when you're in this aspect. We'll do with people before and after death, their families and whatnot. Estate sales, the silver divorce attorney. That attorney, I'd like to have several attorneys available that I'm referring and receiving referrals from because the specialties, right? You don't want somebody who I do it all, just like everything. So the construction specialists that can handle aging in place type, uh, construction upgrades. The senior living consultant, I mentioned that, great source of referrals, as well as somebody that you want to have somebody you can trust if your clients do need to go into an assisted living facility. You don't want to leave that to just the internet. I mean, you build a relationship. You care about these people. You've already helped them with their house. That's just the next stage. Some people even do both. Right. So I work with a lot of groups, referral networks that have all these people in them, and also the senior living consultant, and may also be a realtor. I mean, it's a different, slightly different specialty, but it makes a lot of sense to me. In-home care providers, which is my special, my preference, because people want to sell their house, buy another new one, and then they can live there as time goes on. They need help. They can hire somebody to come in and stay there even longer. There's probably still going to be equity left if they get to the point where they can't and they have to go into a long-term care facility. There's still probably some money for the down payment. If you don't have any money left over, then you're subject to whatever Medicaid will cover, and that means you got a roommate and you know other things. So that not as positive as having a nice place that is accepted large sums of money. So, and again, the tax professional is always important. So these are just most of the ones that I've brought in, and in my silversuperheroes.com. It's my site, and anyway, that's just a portion of what I do. If you want to talk about that later, happy to talk about it. Thank you all for being here. There's You obviously know a lot already because there wasn't a lot of questions, so that's cool. And I'm here for you if you ever do have questions. I want to make sure you have my contact information. My assistant will send out some information to you, to everybody who participated. It's really all in the follow up. So if you got anything that I can help you with, I know Mike. We got a meeting already on the books there. Thank you. And so yeah, happy to help. Um, have a great weekend. Go Hawks. Well, they already went, didn't they? Right on. Cool. All right.
Thank you, Mike.
Cool. All right.
Thank
And I'm off to my next, this Zoom world, Everybody's off to the next meeting. Instead of having an hour in between, you get a few minutes. So I guess it's sufficient. All right. All right. There. Stop the share. And everybody, like I said, take care. Talk to you soon. Have a great day and weekend.